The AI story is so dominant, it is the driving factor throughout markets.
We're starting to see a lot of investor nervousness.
The market wants to see real evidence that the spending is it's getting return. It's turning into margins, turning into profits, turning into free cash flow.
This build-out is not as mature as people think.
The volatility in certain segments in tech has been so dramatic. It's a bad Ouija board at this point.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Wednesday, waiting for Nvidia, holding steady, heading into earnings from the world's biggest company as economists are preparing for another read on inflation in America. And the move lower in oil is helping to put a floor under a rattled bond market. Crude back in the 70s.
Yeah, how much is the entire story of the bond market jitters over the past couple of weeks entirely about oil prices? I mean, you take a look at Fed funds futures pricing in a rate hike at September meeting. And at the last Fed meeting, it was a 65% chance that they were going to hike rates. Now it's currently a 38% chance. Oil prices down 5% in that period, and right now seeming to indicate even lower. So at a certain point, is this a story about Treasury Secretary Scott Bessent and questions around Fed Chair Kevin Warsh, or is this a story about the Middle East and the price of crude?
Oil has certainly helped bring it up. Crude and Brent briefly back in the 70s earlier on this morning on WTI, just above those levels right now on the WTI contract. Over the previous 3 sessions, we've had an 9% move on the price of Brent. That's material. 30-year bond yields down so far this month by around 9 or 10 basis points. That is helpful to this bond market, to this Treasury Secretary. To your point, I think oil's a big factor in the last 24 hours, without a doubt. And on crude, I think you have to draw a big distinction between pricing in a deal and pricing out renewed military escalation.
One of the most interesting reports was reporting that the U.S. was putting ambassadors, putting some of the diplomatic staff back in the region, which indicates that they don't believe there is going to be a reignition of hot war or of more tensions. Even yesterday, when I was talking with Scott Kirby of United, he's been really aggressive, saying oil prices are going to be higher. Even he was saying he thinks that jet fuel prices will slowly go down from here just because people have been so creative about getting oil out of that region. And frankly, you know, he doesn't see things reigniting. Of course, he said, I'm not a geopolitical strategist, even though we all play one on TV every single day. Nonetheless, it does highlight that that is a huge factor behind the inflation.
Can we get the family discount for Sardinia? Have you confirmed that with Scott Kirby?
I tried to get him to sponsor our program, but alas.
He seemed game for that.
He seemed game for that. I think that our schedules are booked.
We'll work on that. Let's talk about where the buzz is right now. The buzz is around this. The Stanley Druckenmiller op-ed in the Wall Street Journal, which, when first reading it, we all felt like it looked like AI. The man himself confirming it was AI. To notice, saying, of course I used AI. I'm not embarrassed by it. I write everything using AI now for the same reason I use a calculator. Bramo, when I do maths problems.
So I have a lot of thoughts. We
Share
don't
them.
have enough time. We don't
We've
need
got time. Please do.
You know, look, number one, I would say, as someone who is a writer in many capacities, I just think there is something to seeing somebody's personality and raw ideas in their own writing and their own thinking. I do think that clarity of writing is often clarity of thinking, and I would like to see just the way that somebody gets to an idea. So it helps me to understand who I'm talking about. He said I was a B student in English, but an A+ in economics. These are my ideas, and I've been speaking about them for over 15 years. A question about what the purpose is of filtering them through some sort of algorithm in order for them to be digestible to us. Is that the appropriate way to be digested through a newspaper or not? It leads to a lot of questions about the role of the media and the role of writing.
We've got some time to talk about this, so let's take the time. I think there's a massive difference between substance and style. I think there's a difference between the opinion and how it's presented, and we should debate those two things separately. For Stanley Druckenmiller, one of the best money managers in history, just absolutely fantastic. I'm interested in what Druckenmiller thinks. I'm told this is what he believes. That's important. It's also important to me how you got to your conclusion. The reasoning matters. Are we using AI to provide an argument for an opinion we already have? I would find that intellectually lazy. That's not what happened here, we're told by Stanley Druckenmiller. So the reasoning aspect of this, how you got to your conclusion, the argument, is very, very important to me. It's important to you. I think we still have an idea of how we got to his conclusion, his reasoning. The style, I think, is a much bigger conversation for our industry in journalism. If you're at the Wall Street Journal, and for any other publication for that matter, do you want to be in the business of selling AI slop? I would argue probably not, and I'm not sure many people want to buy it. So if you're going to have, and this is not just a journal problem, it was an FT problem more recently too, people submit their opinion in essays that is clearly written by AI. Just take out their opinion and present it in a different way. So, for instance, with Druckenmiller, I'd actually prefer a picture of the raw notes that Druckenmiller made to get to the argument that he provided to the Wall Street Journal than something sort of synthesized through some AI bot that just looks like signature slop. Are you with me?
Yeah, well, it seems like in the past, journalists were the filter, or the writer of an article is the filter for one of these behemoths in an industry, their ideas and their reasoning. Then the person could just write directly, and now the filter is artificial intelligence and different algorithms that can then filter it for everybody else. I would argue there is a real question around what is the correct filter, given the fact that the person might not want to write a sort of full-length article. And you could argue maybe they shouldn't have to, because everybody can run their ideas in whatever raw form, to your point, through their LLM of choice, and they can get their own document. But ultimately, it raises a question of what form of information you really want to buy access to. And ultimately, that's going to be really key for not only the media industry, but also for financial analysis more broadly.
And this is just the start of the conversation in many ways too.
Watch out, 3 hours.
Right, what are we paying for? I think Citrini had this social media post yesterday and we talked about it. And it made me laugh. And the prompt was basically, criticize the Treasury Secretary, don't make any mistakes, dear Claude, something like that, right? If that's the world we go into, I find that really, really lazy. If you're not coming up with your own original argument to get to a conclusion, if you're just providing a conclusion to a chatbot and saying, give me some evidence because I'm too lazy to come up with it myself, I just believe this, and then it comes up with an argument for you, that's a very, very slippery slope. That's a dangerous place to go.
But this is the reason why we're talking about that exact point, that this was Druckenmiller's way of trying to criticize Scott Bessent, less about the argument at hand, which a lot of people would agree with. And maybe that was the message that got through, because this was not something that was rationalized through his mind or reasoned through, that he spent all weekend vociferously writing.
Druckenmiller got everything he wanted out of this.
He did.
Right? This is what he believes. Everyone knows that now. And everyone's talking about it for a second day.
I know. You know what? Congratulations. I'll use AI.
I have to say, there wasn't even a crisis in the bond market to begin with if the Treasury Secretary didn't step in the way he did a week ago. Yeah. Right? No one would be talking about this. Okay. Yields have come back in. We'd just be like, Kevin Walsh, it's over to you in a few days' time.
If I were a kid and I were watching this, my lesson would be use AI for every project.
If you were a kid and you're watching this accidentally this morning, you'd be like, who's Stanley and why is everyone so obsessed with what he's got to say?
I want Cheerios.
Stanley's an important guy, OK? Coming up this hour, we'll catch up with Marvin Lowe of State Street, heading into another read on inflation. Sarah Kunst of Cleo Capital as chips rally ahead of Nvidia earnings. Andrew Balls of Pimco as the Fed's bark-in warns of a potential US debt reckoning. We begin this hour with stocks and yields holding steady ahead of more earnings and inflation data later this morning. Marvin Lowe of State Street writing, while recent data has thrown a bit of cold water on the strength of the economy, we don't find a reason to fade the view that the Fed will still need to tighten before year end. Marvin joins us now for more. Marvin, good morning, sir. It's good to see you. Do you expect to get a guide from Kevin Walsh in a few days' time on that?
You know what? We're not going to hear from him with regard to what he thinks September is going to look like, or even December is going to look like. All we can hope for is that we get a little bit more sense into, what his thinking is, how the Fed's going to actually approach the concept of the reaction function, and really to give the market a little bit more comfort that July is not the way the Fed operates and not the way the new chairman operates.
How do you think the Fed operates and the new chairman operates?
Well, I think it's still, generally as divided as we saw at the beginning of this year. Those opinions are out there. Certainly the data has given the Fed a little bit more room to think about things, but you continue to have half of the committee that thinks that there is a fairly low hurdle with which they should hike rates. And I think that winds up being a theme that we take into the latter part of this year.
To your point, Marvin, we even heard from Susan Collins, somebody who previously had been in the hold camp. Yesterday, she had an essay where it seemed to be a bit more hawkish, saying that the onus is on the inflation data to keep getting better for her to remain on hold. Otherwise, it might be appropriate to tighten. Where is the inflation coming from if it isn't coming from oil prices, if it isn't coming from some of these supply side shocks?
Yeah, I mean, for sure. After 5+ years of this kind of embedded inflation, that is the concern of the Fed. forward guidance and forward expectations around inflation is ultimately the self-fulfilling prophecy. And I think that that's the risk, that we've got a Fed that, theoretically is remaining patient in the face of an inflation target, which is starting to mean nothing. And that influences both the services part of the economy, which certainly is the bigger part of what we wind up generating wealth from in this country. And it's something that, standing on the sidelines, becomes less and less acceptable.
Isn't this a data story, though, and less of a Kevin Warsh story? I mean, what can you learn from Kevin Warsh that gives you a sense of whether or not, the degree to which they are prepared to hike rates later this year?
Yeah, I mean, certainly data is always going to be an important part of this discussion. And, we've got this kind of little bit of soft patch in the middle of the summer. We'll see what August inflation looks like. Our readings kind of around August inflation, kind of in a more real-time perspective, is that it is coming back to a certain degree. So, that cat is not completely shoved back in the bag. But it also is a story about U.S. growth. It also is a story about demand for duration capital in the U.S. and globally. And what we need to learn from Warsh is how he parses the data as well as kind of this R-star capital demand perspective. And, clearly the Treasury Secretary is throwing his hat in the ring around that longer term duration story and that broader demand for capital. And for me, it's always been part of why we need to think about tightening, and that hasn't changed.
Marvin, do you care that Druckenmiller used AI? Weigh in, please. That's where the buzz is right now.
Yeah, I don't. I loved your conversation because I have the same on the trading desk every day. I still write all of my work. I find that the actual writing helps me think. I think my analysis improves as a result of that. So, call me a Luddite. I'm not necessarily willing to allow it to write my my analysis. But, Stanley Druckenmiller has all the street credit that is needed. And it's fine that he uses AI.
Marvin, it's good to see you. Marvin Lowe of State
Nice to see you too.
That's where a lot of people side right now, at least this morning on that issue.
Well, he's proven his mettle. It's not as though he needs to show something. It's not like he's looking for an English teacher to give him an A+. Ultimately, he's just trying to communicate ideas. I think, though, the interesting thing is it means he wasn't thinking through these ideas. He was saying, hey, AI, express all my views and direct it to Treasury Secretary Scott Bessent. And that was the message that everybody heard.
Precisely. That's where the value is.
Yeah, exactly.
Not the argument, the fact he signed off on it.
Correct. And directed it toward a specific event.
Yes, and we're still talking about it this morning. Futures negative by about 0.1% on the S&P 500. Bond yields a little bit higher after pulling back over the past few days, and over the month so far doing better on a 30-year side of things. Let's give you an update on news worldwide with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Good morning, John. The White House is considering additional trade penalties against Canada. This after Prime Minister Mark Carney unveiled dollar-for-dollar retaliation to new tariffs imposed by the U.S. Additional escalation could include higher levies and other trade actions. Meta and state attorneys general have discussed a possible mid-trial settlement in its teen social media case. The company accused of deliberately designing Facebook and Instagram to addict teens. Meta believes a loss at trial could result in penalties of as much as $1.4 trillion. SoftBank holding talks for a potential $10 to $20 billion bond offering to help refinance a loan for its investment in OpenAI. Sources telling us here at Bloomberg the proceeds from the sale would be partly used to repay a $40 billion bridge loan. And that is your Bloomberg brief. John.
Hey, Vonnie, thank you. Thanks for the update. More from Vonnie in about 30 minutes' time. Up next on the programme, asserting control over Iran.
Iran is broke, totally broke. They're not going to make the kind of a deal that I feel is necessary.
We have total control of that entire region having to do with the Strait of Hormuz.
Up next, Colonel Wayne Sanders of Bloomberg Intelligence, live from New York City this morning. Good morning. Stocks this morning slightly softer. We're down 0.1% on the S&P. On the Nasdaq, we're down by 0.2%. Later on this morning, PCE data at 8:30 Eastern Time. The move in inflation helping to put a floor under this bond market. Inflation pretty much in line on CPI. PPI softer. Retail sales were weaker too. We saw this with payrolls as well. That's brought yields down at the front end, 2s to 420. Crude on the move lower on oil more recently, helping to bring yields down at the long end as well, 517 on 30s. And WTI briefly in the 70s. WTI this morning, $80 and down by close to 3%.
Yeah, so discussions around negotiations with Oman and Iran about establishing some sort of corridor of the Strait of Hormuz. A real question here, though, about what inflation is going to be relevant to this Federal Reserve. We talk about how oil can be transitory. How about the data center build out and the AI-related inflation? How do you consider that? Is that a one-time price shock that then's going to disinflate? A lot of questions in the mix, and oil just sort of sets the tone for a lot of these other ambiguous features that are filtering into the data.
How many times will people say this morning the Fed's preferred gauge of inflation comes out at 8:30 Eastern Time?
Perhaps.
There's a big maybe around that now.
Honestly, increasingly people are saying this is inaccurately skewed by data center spending and doesn't actually reflect the inflation in the system. Problem is, what does? And that, I think, is a little bit more of a question.
You'll be there. Do you think that's part of the conversation this week in Jackson Hole?
I think it is the question, actually, the inflation mandate and the inflation gauge. Also a question of what does an inflation target mean? This is something that Alan Greenspan actually did not want back in the day, and he didn't want there to be some sort of explicit 2% target when it came out, and Janet Yellen supported it, who was on the Fed board. He was actually upset. So there is a lot of hair around this that has to be established.
I saw TK coming down the escalator moments ago with a suitcase. He's getting ready to leave. He's flying out today. Yeah. You flying with him?
I don't know. Maybe he'll be on my flight, but I'm guessing that he'll be in a different class.
He's a United guy. United Airlines. So probably from a different airport, too.
Yeah, probably. And probably, taking up the first row.
I have no doubt. I've been squeezed a few times on those trips, yeah. Looking forward to the special programming from Bramo, TK and the team coming on Friday at 9 a.m. Eastern Time. Under surveillance this morning, let's talk about the backdrop for oil asserting control over Iran.
Iran is broke, totally broke.
They have no money.
They want to make a deal, but they're not going to make the kind of a deal that I feel is necessary.
We have possession, complete control of the Strait. We have total control of that entire region having to do with the Strait of Hormuz.
So here's the latest this morning. The Trump administration narrowing in on economic pressure on Iran. Axios reporting the Secretary of State Marco Rubio told several foreign ministers the U.S. is holding off on strikes for now. The shift happening as Iran and Oman discuss an interim framework for reopening the Strait. Joining us now is Bloomberg's Abu Amar. She joined us now from Dubai. Abir, welcome to the programme. How much progress are we making on the diplomatic side of things?
Faint progress, I would say, John. Good morning. So what we know is that deal that we've been speaking about on this show and multiple other shows between Iran and Oman, the final stages, we seem to be at some final stage, this joint corridor, maritime corridor, for a temporary period of time, at least for the next 30 to 60 days. That was the joint statement that Iran and Oman came out with yesterday, suggesting some kind of reopening in the Strait of Hormuz. Now, the mechanism has a little bit of details about inbound and outbound ships and just what pathways they're going to be taking. But perhaps the most important out of all of this is further negotiations are set to take place for a more permanent solution in the Strait of Hormuz. And some of the clauses that were brought up were interesting, namely the one about the management over the Strait of Hormuz. Now, we don't know what the U.S. is going to respond to that with, but of course, the United States and Gulf countries that are in the region, the biggest oil exporting region in the world, of course, have vehemently refused in the past for Iran to have any management over the Strait. But we don't have a lot of clarity about what that management is going to look like. But then again, in the joint statement, both countries did say or alluded to the fact that Persian Gulf countries may be included or may take part in the wider negotiations happening. But when it comes to the wider negotiations, John, between the United States and Iran, those are, of course, nowhere in sight. You also mentioned Rubio talking and saying how the U.S. is not planning on military strikes or escalating this once again. And we have some NYT report from the morning suggesting that some staff that did leave at the peak of this war from the United States might be coming back to the region. So maybe a little bit of truth behind that statement.
Abir, it's good to see you. Thanks for getting us up to speed. Abir Abu Amar there out of Dubai, covering the story for us out of the region. Colonel Wayne Sanders of Bloomberg Intelligence joins us now for more. Colonel, welcome to the programme. It's difficult for me to sit here and believe that the kinetic phase is behind us and that in front of us is diplomacy and a path towards peace. Colonel, do you think there is a path towards peace from here?
Yeah, I think that there is. I think that one of the biggest pieces right now that you're seeing with this coercive diplomacy is really both sides recognizing that the kinetic fight right now, the conflict, hasn't really done a lot for either side to be able to get what they want. So this transition over into this additional piece for this coercion side, both sides are talking about what they're going to do. President Trump even brought up potentially bombing Oman, in terms of that. Iran looking at it in terms of, hey, anybody who partners with the United States, better be prepared for retaliatory attacks. So I think that the kinetic fight is always something that is going to be out there as a potential. But looking at it in terms of where their strategy is right now, I don't think that's at the forefront.
Colonel, I don't want to be skeptical here, but let's say there is this pause, it's a prolonged pause in kinetic activity. Who has the upper hand in terms of how quickly they can manufacture additional ammunition? Is it Iran or is it the United States?
It's a tough one. I would say that from the standpoint of scalability, it's easier to build a Shahed 136 drone. So I would give from that perspective the types of munitions and the types of capability that Iran is looking to produce. They can scale that faster than the U.S. is going to be able to scale PAC-3 interceptors or Tomahawk missiles. So for that perspective, I do think that Iran would have the lead on that. But what you have seen is a lot of change in that doctrine in terms of how they're doing the counter-drone fight, not using some of these exquisite interceptors to go toe-to-toe with Iran on that. We transitioned a lot into gravity bombs, which obviously the U.S. still has tens of thousands of. So I don't think that part is really in play. I think it really comes down to what is the impact of what you're trying to do. So let's say Iran does scale. They have all of these 136s. Where are they going to do with that, and what has it actually achieved up until this point? And then the same thing for the U.S. attacks on Iran.
What can be achieved through financial means? In other words, do we get somewhere other than where we are currently, or is this kind of the only place we can stay without it really devolving into either military conflict or, on the other hand, some sort of peace agreement?
Yeah, President Trump, he hits it on the head when he talks about some of the economic hardships that Iran is going through right now. The problem is that some of these increased sanctions that are on the table for this, part of the problem that you run in there is that the number one economic lifeline for Iran is China, especially when you look at 90% of the oil the oil exports from Iran going into China. So then the question really becomes, how much leverage are you trying to place onto Iran without upsetting the relationship with China, especially we have, September 24th for President Xi coming. So we're running out of time on that as well.
Colonel, you can make the argument that China is more important to Iran than Iran is to China. Going after China, how much of a difference does it make to China directly?
Directly, I don't think it's going to. I think that it's mainly going to be the fact that China on the global scale has already now said is, hey, look, we're not going to stand idly by. They're not pro-Iran-U.S. conflict, but at the same time, on the sanctions side of the house, they're also not going to stand idly by and let U.S. dictate across the world global trade. And so I think that there's a certain amount in terms of where that leverage is as the U.S. continues to push, how much of those sanctions we put into place before China has to respond.
Colonel, it's good to see you. Always appreciate and respect your experience, sir. Colonel Wayne Sanders there of Bloomberg Intelligence on the situation in the Middle East. The Treasury Secretary, Scott Bessent, said a financial institution would be sanctioned, I believe, this week. Watch this space.
Really interesting to see whether that's going to be in China, because ultimately all eyes do lead to China. All roads do lead to China when it comes to the Iran relationship. They still are the major trading partner, the major buyer of Iranian oil. It is important to note, though, that their oil purchases have gone down significantly tied to Iran. The question of whether they want to appease the U.S. or whether they like that the U.S. is kind of sort of busy with this quagmire and taking some of their focus out of Southeast Asia. These are some of the things that are definitely going to come to the fore.
I remember all these different deadlines. We had to get it done by then. We had to get it done by then. And here we are going into September, and it's still not done. I remember that social media post from the president was April 17th, the Straits reopening. We were down in Washington, D.C. at the time, heading into the weekend. Strait didn't reopen. Here we are months later, waiting for the same thing.
Yeah, right now I think a lot of people are saying if we stay here, that might not be the worst thing. At least we're not getting substantially worse.
Up next on the programme, Sarah Kunst, the Cleo Capital, looking ahead to results from Nvidia. Results from Nvidia drop in after the close. You're week ahead looks like this. It starts this morning with PCE data at 8:30 Eastern Time, continues this afternoon with earnings from Nvidia. Then it's on to Friday. Skip claims on Thursday. Never any real news there. Maybe that changes. I don't know, but...
Now that you said that.
Right. Then we've got Mitch on Friday too. And then it's the big one. It's Kevin Walsh addressing Jackson Hole, Wyoming, heading into the weekend. Bramo's going to be there alongside TK and the whole of the team to break this down. It's a big moment for a new Fed chair.
If he doesn't say anything, that's saying a lot. If he does say something, we'll get some view on exactly who is Kevin Walsh as the chair of the Federal Reserve in 2026. A lot of questions about the reaction function, a lot of questions about what gauge of inflation matters. And I would say one of the more important things is how does he think of artificial intelligence when it comes to inflation? He has talked about it leading to productivity and disinflation, considering this is one of the main drivers of ongoing inflation outside of commodity prices. It's a really important question.
Did Claude write the speech?
For him?
We all want to know.
I don't know. What would he even put for the prompts? I think a lot of people would pay to see the prompts that he put into Claude for that speech. So I think there still would be that.
Clean up the news conference from a few weeks ago and insert my thoughts from the FT piece. Published the following week. Maybe.
Claude, clarify. Were those your thoughts? Just a suggestion.
Let's turn to the market. Equity futures right now declining just a little bit. No drama here. We're down by 0.1% on the S&P. A bounce from Monday's losses in Tuesday's session, underpinned by a better day for tech and a better day for the semis. Helping to underpin that move higher, we snapped a 7-day losing streak on Nvidia heading into earnings this afternoon. In the bond market, 2s, 10s and 30s. As we talk about Kevin Walsh, think about that news conference. Before that news conference even started, the morning of the last Fed meeting, the 30-year bond yield was just south of 5.1%. This morning, it's at 5.17. It's not bad. It's had a helping hand. It's had two. One's been the moving crude and the other has been the Treasury Secretary with a big decision, a big move a week ago.
Yeah, talking about buying back a significantly bigger proportion of 30-year notes, potentially using the general account, although that hasn't been confirmed. Interesting, we talk about how effective that's been and how difficult it's been to stay still. Some people have argued, actually, it's been quite effective in at least squeezing out certain short sellers that now are not putting on those bets, given the fact that they have a pretty big whale on the other side of them. And there have been studies showing that maybe on the margins he brought down the costs, but he also really highlighted how much the fiscal deficit is in focus. And now you even have Fed officials, Fed governors, talking about how this is a real problem and ultimately it is something that is going to bite.
And this number right here is helping. The price of crude, WTI and Brent this morning. Yesterday, closed below 90 on Brent for the first time since mid-August. 86 right now and down another 3%. WTI briefly this morning in the 70s. At the moment, WTI $80.20 and down by 2.6%. That's some of the cross-asset price action as we count you down to the cash open 3 hours away. Let's get you some single names, some morning movers. Yahira has more. Hey, Yahira.
Hi, John. Software is back in the spotlight, and not for good reason. We are seeing Intuit shares falling nearly 13% in the pre-market after giving a much weaker outlook than Wall Street expected. TurboTax revenue is expected to grow just 2 to 3%, and Jefferies points out that is the slowest growth for that unit in more than a decade. But the bigger issue, of course, is that it's coming at a difficult time for software where investors have started to question how vulnerable it is to AI. Plus, the bar has been high since you did see software rally off the lows of earlier this year. And sticking with that pressure on software, we are seeing Zoom also falling at 6% in the pre-market. Its outlook also failed to impress investors. This is a company that has been working on expanding beyond its video tools into things like corporate phones and AI tools. So investors were looking for a much bigger payoff from that, but they did not get it. Revenue came in just in line, while profit came in a bit light. And we are seeing USA rare earths and critical metals extending their gains from yesterday. Critical metals was up 21% yesterday as investors bet on more government support for this industry. That's because earlier this week, Washington backed a more than $1.5 billion financing package for USA rare earth. And that's helping to lift expectations that you could get more funding and more purchase commitments from the U.S. government as it tries to reduce its reliance on China. John.
Yahira, thank you. So much has been written about an activist Treasury in the last week or so. We have an activist White House. We've had an activist White House now for the last 18 months.
going after direct investments in a whole host of different companies and picking winners and losers. And ultimately, if there is a cohesive idea behind it, if there is a predictable pace to what they're doing, sort of similar to what people have said about Treasury buybacks, then people can wrap their head around it. It's really a process issue more than the actual action itself.
Is this the new normal down in Washington, D.C.? And if the Democrats manage to win 2028, under a party that's shifting further to the left, what does that intervention, that activism look like under that government?
You could argue this has been going on for quite a while. I mean, it was bipartisan with the CHIPS Act and what was passed in terms of direct investments to different areas. And you have seen the executive branch consolidate more and more power. If you have increasing involvement with the private sector, is this the path of travel? Ultimately, is going to be a big question on the ballot. This is one of the reasons. This is actually one of the big talking points heading into the November election.
You have to really think about what we're normalising here down in the nation's capital. On our radar this morning, crude falling for a third day as Iran and Oman hold talks to reopen the Strait of Hormuz. Discussions are set to continue between the two countries for a permanent route through the waterway. Elsewhere, the US-Canada trade war still heating up.
No deal is better than a bad deal. And we have to go tariff for tariff and dollar for dollar. And it's unfortunate. We had an attack from President Trump. It'd be more productive if we actually sit down and the Prime Minister and the President sit down and have a fair deal for everyone.
The Trump administration weighing additional levies against Canada after Prime Minister Mark Carney unveiled dollar-for-dollar retaliation. The Ontario leader, Doug Ford, maintaining his support for Carney's response. And finally, billionaire investor Stanley Druckenmiller admitting to using AI to write an op-ed in the Wall Street Journal criticising the Treasury Secretary's bond buyback plans. Druckenmiller telling Notice, quote, "I'm not embarrassed. I write everything using AI now."
I was thinking more about my knee-jerk reaction, which is this is terrible. It violates the process of writing. It's very much a Luddite view based in the fact that growing up, that is what I did in my free time. I really enjoyed it. It was a way of my going through my thoughts. And in the classes, it was really about the way you organized your thoughts, et cetera. Is there a difference between using it in class and using it in a workplace? Well, obviously there is to some degree. How much is this an issue of disclosure? How much is this an issue of the purpose of said writing? Ultimately, these are questions that we're going to be grappling with, because if it is a tool just to express our thoughts more clearly in a more acceptable way or digestible way for the public, why is that a bad thing inherently if the views are established by somebody who already has a reputation and a track record? On the flip side, it does feel like we are muddying the waters of personal expression, and I think that really does have to be clarified in some capacity in a very different era.
So let's start with this question: where's the value, right? Where's the value for you, and where's the value in general? The value for me is, what does Stanley Druckenmiller think, right? There's value in that. I've got value from that. I don't really care how it was written from that perspective. I just want to know what he thinks and get an idea of the general argument behind that conclusion. So we can park that. Then there's value to you, and I think your perspective matters. You value writing and good writing, and you want to be able to read a story that makes sense and has a nice thread and keeps you reading, right? That's important. That should be important to the Wall Street Journal, because if the Wall Street Journal is just going to put out AI slop, you're not going to pay for it, right? I can get Druckenmiller's opinion without even buying the Wall Street Journal in the last 24 hours, without even visiting the website, because I know everyone's talking about it and they've put that quote in several different places. Everywhere. We're all talking about it all around Wall Street for the last day, and we'll continue to talk about it for the next week. So there's value in understanding what Druckenmiller thinks, one. But then you have to understand from the media perspective, is there value in going to the Journal to read the story? And based on the fact that it was put through Claude, Gemini, ChatGPT or whatever, there's obviously not. And the Journal, and not just the Journal, but every publication under the planet needs to figure that out.
And a big part of this is disclosing that AI was used when creating different stories. I think a lot of this comes down to disclosure. I'm fine with AI assisting. I'm fine with AI being part of the process. In many ways, it has to be, given the fact that this is the new normal that we live in. It's a matter of disclosure. And the Wall Street Journal was fine with it, the op-ed page. You saw the FT come out and actually have to run a clarification around a Richard Hausman article of Harvard, where it said that they used artificial intelligence to consolidate some of the piece. So some real interesting questions. A lot of it does continue to have to be hashed out.
It's funny how many different dimensions there are to this conversation.
It's endless.
It's totally endless. Let's talk about some real news for you. Nvidia snapping its 7-day losing streak heading into earnings today in another test for the AI trade. Sarah Kunst of Cleo Capital writing, we know Nvidia has solid quarters. What we don't know is how many quarters of blistering demand are left. Sarah joins us now for more. Sarah, welcome to the programme. Are we at the point where you believe this market is beginning to price in deceleration?
I think so. I think that there's starting to be more question marks, and there's also going to be a lot more answers as OpenAI, as Anthropic, sort of move into their presumed IPOs. They're going to have to talk a lot about kind of where they're spending money and how much they're actually spending. One thing we forget a lot is we don't have much insight into who's paying to use AI right now, and that is a huge question for Nvidia, because if people aren't paying, eventually their chips are going to seem a little bit less appealing.
Sarah, this competition, how serious is it? I saw another story from OpenAI. This is your world, it's not mine. I'm told and I understand this is a very complex industry. It's difficult to make these things. If it wasn't, everybody would be doing it. How advanced is the competition?
So, I think about a year ago, I said, hey, Nvidia probably has a 2-year lead still, right? Now we're halfway through that. And you're seeing things like OpenAI come out and say, hey, we have some really, really good chip design as well. Now, it's OpenAI, so you have to take everything they say with a grain of salt, kind of Elon style. But the reality is that we know that this sort of hyperscaler arms race has meant that a lot of very smart, very well-funded companies are getting more into chip design, whether that's the OpenAIs of the world, Meta, Alphabet. So certainly Nvidia won't have this huge head start forever.
At the same time, Sarah, how much does this ultimately matter for the earnings report that comes after the bell? Is it a competition story, or is it a financing story, or is it what Nvidia means in terms of financing the entire ecosystem? In other words, is it the financier or is it the supplier of chips that's more important to markets at 4:20 p.m. Eastern today?
So I think that actually it's the forward looking. I think that understanding how they are viewing, they're very good at telling a story on these calls, telling a story to the street, so the street knows what to expect. So I'm really focused on what they say is going to happen in terms of this year. Any forward looking statements I think are going to be incredibly important to understanding, are they getting nervous? Because when they start to get nervous, I think that the rest of us should be a little bit cautious.
If they aren't nervous, which is most likely, and they do talk about a robust pipeline, which is what we heard from TSMC and a bunch of the others, do you expect that to be a positive for markets, or do you think markets can't be satisfied no matter what, as has been the case over the past few earnings seasons for Nvidia?
So I think on the credit stuff, I think on the round tripping, the markets are getting pretty wise to it, and I think they're getting a little sick of it. And so I do think that there is muted enthusiasm. There's also just larger secular trends. People are not liking data centers, and if data centers can't be built, then where do all these Nvidia chips go, right? And then also the capacity issues. You look at the fact that everyone from SpaceX to Meta is leasing out all of this space, all of this demand. It really indicates that maybe no one's quite sure yet how much AI they're actually going to be using. And again, Nvidia can have the best chips in the world. They largely do. It doesn't matter if no one's buying them.
Sarah, it's good to see you. Sarah Kunst to Cleo Capital. That last line I think is really important. We often describe Jensen Huang as the godfather of AI, the spokesperson for the whole industry. How does he weigh in on the situation with the politics and how quickly it's moving in this country?
I think he has talked about the desire to keep in this race. He's talked about open source versus closed source. But to the degree of data centers, it's going to be a tricky one, because anything he says is going to be viewed through the lens of being incredibly self-serving. So probably the less he says, the better it will be received.
Nasdaq futures this morning negative by about 0.1%. With an update on news worldwide with your Bloomberg brief, Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. OpenAI claiming new processing chips, dubbed Jalapeno, can outperform Nvidia's current lineup in testing. The ChatGPT maker plans to deploy the chips later this year to power its AI models. The move joins a growing list of firms looking to build their own semiconductors. London bus drivers have resumed a strike over working in the sweltering heat. According to The Guardian, about 1,500 union members in North London and Essex are taking part in the 4-day work action through Friday. New York Mayor Zoran Mamdani pushing for a more affordable U.S. Tennis Open. The Mayor and the U.S. Tennis Association are offering city residents 1,000 discounted tickets on sale starting 10 a.m. Eastern today. New Yorkers can buy up to 2 tickets if they can get them for $100 each for main draw matches. And that is your Bloomberg brief. John.
Vonnie, thank you. Thank you very much. We can complain about that in a few weeks' time.
Well, complain.
Do you want to start the complaining now?
Well, I think that
Not the move to get cheaper tickets. That's a great move.
I was about to say, I think this is one place where Zoran Mamdani and you actually completely agree, and it seems like, you know, you would support
We
this.
agreed on the FIFA stuff too.
Yeah, so when it comes to sports,
Found
the
a very
great uniting
piece of
feature
common
of us
ground.
all. There we go.
Okay. Next on the programme, a debt reckoning.
Our deficits are not getting any better. This is a government-wide issue. We're spending too much.
Treasury does have these tools and the ability to reduce issuance at the back end of the curve. I think that would send a more impactful signal to the market rather than just these buybacks.
It's more symbolic than anything.
Andrew Balls of Pimco joins us next, live from New York City. You're watching Bloomberg TV. Yield stable this morning at the long end of the curve, around 520 on 30s, 517 at the front end, yields higher. Heading into PCE, up by 2 basis points at 419.70. Under surveillance this morning, what many are calling a debt reckoning.
Our deficits are not getting any better. It's not just the Treasury, right? This is a government-wide issue. We're spending too much.
Treasury does have these tools and the ability to reduce issuance at the back end of the curve. I think that would send a more impactful signal to the market rather than just these buybacks.
It's more symbolic than anything. The market's going to perceive it temporary.
So here's the latest this morning. Elevated Treasury yields and the threat of intervention facing off against fundamentals. Richmond Fed President Tom Barkin warning of a, quote, reckoning if US debt continues rising. Andrew Balls of Pimco writing, don't get carried away. Volatility in bond markets remains at relatively low levels and a lot of what is happening is healthy. Andrew joins us now for more. Andrew, welcome. It's been too long. What is happening right now that you believe is healthy?
Great to be here. Thanks very much. Well, yes, there's so lots of noise, but when you look at what's happening in fixed income markets, there's reasons why yields have moved higher this year. The situation in Iran and oil prices, of course, some concerns on fiscal, and then the AI issuance, the hyperscalers. Their issuance has become very significant in terms of the amount of debt and a lot of it's at the long end of the curve. But when we step back, yes, yields have moved to higher ranges, but we are back to the sort of yield levels that prevailed before 2008. So in some ways, kind of the aberration was the period of QE and zero interest rate policy, etc. And then just, the 30-year, yes, there's been some focus on the 30-year part of the curve in the US. But if you look at the 10-year 465, we've been using a reference of kind of 375 to 475, going back a few years now with a higher end of that range. That may make sense, but still within the range. And when you look across other global bond markets, it looks pretty similar. It tends to be at the higher end of the range of the last few years, but in that range.
Andrew, two-part question. If this is the return to the old normal, why is the Treasury so uncomfortable with it? And if the Treasury is so uncomfortable with it, how sustainable is a return to the old normal?
Well, it was interesting. You had a spate of news stories on the long end, and I was slightly scratching my head on this. And then you had the announcement in terms of the buybacks, which gives some credence, I guess, to the concerns in a way. And maybe this is just kind of a political reaction. Of course, we have a very different administration to the administrations we've had in the past. On the interventions itself, it's going to be interesting to watch. It's not quite clear to me why you would want to step in now. Volatility has not been high in terms of fixed income markets, again, within the ranges, as I said. So I think we'll watch now to see the behaviour, how much they are spending in the buybacks, where they are bidding versus the mid or on the spline, and just to get a sense. But it's not 100% clear to me why they would be doing this now, or what the definition of success is, other than there may be an idea of drawing a line in the sand, not wanting to see an ongoing rise in terms of 30-year yields, which of course markets may want to test that.
Andrew, it makes sense to say that economically yields should be higher, that it makes sense for them to be so. At the same time, it creates that much more focus on the $40 trillion deficit in the United States. And every time the yield moves higher, it gets incrementally more punitive for the United States to finance that. At what point do we enter that doom loop, and does that become a problem in its own right?
Well, I think you're right. I mean, the main thing here is fiscal. These interventions are certainly interesting, and it's been an interesting few weeks. Also, of course, with currency interventions earlier in the summer. But the big thing is fiscal in terms of the outlook for the U.S. debt market and yields. I don't think anyone is expecting any significant improvement in the next couple of years, but in the long term, in order to anchor the market moving away from a world of kind of 6% structural deficits is going to be very, very important.
Andrew, just to break in here, for you as a bond investor, when does it sort of hit that threshold? I mean, that was sort of a question that people had as the 30-year yield rose, that at what point does it keep rising because there wasn't a sustainable remedy to the deficit and there wasn't the political will. Is there a trigger point that can be breached and then it becomes really problematic for you as a bond investor?
So we tend to look at the long-term outlook and 5-year, 10-year and longer. The US, if it remained on this path over that long period of time, would see a continued rise in debt to GDP. In the short term, as I said, we're not expecting much of any significant improvement, although the Treasury have said that they have plans. I think when you step back, we get compensated for the risk as we see it. Again, at the higher end of the ranges where we've been, if you have a high quality bond fund, the yield's 6-7%, something like US or global ag, that looks like very good compensation. So you are being paid for this deterioration in fiscal metrics, which is global. I mean, you see this across the world, not just a phenomenon in the US. And so I think that keep calm, carry on. There's good equity-like, as we would see it, compensation for the risk. The outlook is a difficult one in terms of the long-term US fiscal outlook, but we're getting compensated for the risk as bondholders because of the very significant repricing you've seen. If this was back to the very low levels we had in 2020 at the height of the COVID pandemic, it would look very different.
Andrew, I've got 30 seconds. Do you feel the same way about USIG?
Yeah, I think USIG, that now there's going to be pressure from the extent of the issuance from the tech sector, so be careful on the tech sector in particular. Do the bespoke deals, the special deals. Overall credit spreads look tight, but okay. But be careful, I think, in terms of technology. Don't have the generic exposure. Go and do the deals where we can get excess yield, excess risk premium.
Andrew, it's good to see you. Thank you, sir. Great timing. Andrew Bulls there of Pimco, a man himself who spent some time in the media in years gone by. Should have got his opinion on the Wall Street Journal piece.
Yeah, actually, that would have been really good.
Former journalist himself, he would have had some thoughts, I'm sure.
Maybe. That would have been really good. Andrew, please come back and give us those.
Up next on the programme, Dan Skelly of Morgan Stanley, Tobin of Wolfe Research, Capital Investment CEO Marvin, and Conrad DeQuadros of Citi. The second hour of Bloomberg Surveillance is just around the corner.
There is kind of this push-pull between what Warsh is looking at, what Bessent wants to accomplish here.
Will Kevin Warsh say that we have a fiscal issue that's driving the inflation side?
We've had a change of leadership at the Fed, and we're still trying to figure out how they're going to react.
If the Fed does hike as we expect, typically that does lead to some pressure in the long end.
The Fed's inflation credibility, shockingly, after 6 years of missing the 2% target, is still very much intact.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now, and your price action scores look like this. Equities negative across the board, slightly lower. We're down by about 0.1% on the Nasdaq 100, pretty much unchanged on the S&P. In the bond market, yields have stabilized at the long end around 520 this morning. Yields slightly higher by a basis point at 517. In the commodity market, this move has helped stabilized fixed income. This move in crude. WTI and Brent briefly. WTI this morning in the 70s, 80 right now, and down by 2.7%. Heading into this later this morning in 90 minutes time. PCE data later this afternoon. Earnings from Nvidia. Then just a few days away. Kevin Warsh, Fed Chair, speaking in Jackson Hole, Wyoming.
You know, normally we'd care about PCE. I understand that we know what it's going to be just because of the inputs that we've already gotten in terms of the data. But normally, this is the key inflation metric for the Federal Reserve. Wouldn't we be excited to see what this is to determine Fed policy? And no one seems to care. Everyone's talking about Kevin Warsh instead and what Scott Bessent is doing over at the Treasury. And it gives a sense. Is the story about economics? Is the story about oil? Or is the story about a lack of understanding from the U.S. Central Bank, how closely it's working with the Treasury Department and what it's looking at to understand what action it needs to take?
That's the story now. It wasn't before. We should have been focused on a string of weaker than expected data, retail sales payrolls, and then a soft PPI print as well, which should have taken some of the steam out of the hawkish argument into September. For some reason, it hasn't happened that way at all, and the hawks are still hawkish a few weeks out.
And even some of the doves are becoming more hawkish. I mean, Boston Fed President Susan Collins yesterday, in a speech that she released, in a statement that she released, said that ultimately you need to see more inflation, more evidence that inflation truly is coming down in a sustained way, and that the data that we've seen over the past couple of weeks isn't enough to take the possibility of a hike out of her mind, that ultimately she's very concerned. Is this an issue of just impatience? Is it just a time issue with how long inflation has remained above 2%? Or is there something else, a fear of losing that credibility that we talk so much about?
All three. I think 1 and 2 are connected. I think being above target for so long has led to this impatience, this moment, and the lack of clarity on the third point is raising questions about credibility. The performance in the news conference a few weeks back has done a lot of damage to how the institution is perceived. It's why there was a clean-up act in the FT. It's why there is so much attention on this speech in a few days' time.
Yeah, and then there's a real economic debate here about what inflation metric we should be using. And I did go back and look at some of the Alan Greenspan era when the 2% target was first put on, and ultimately why it was and how it was perceived at the time. If this is a new Alan Greenspan Fed, do you expect a similar discussion to take place, with Kevin Warsh possibly saying it is a mistake to target with any precision a 2% target? Not saying that we don't want to bring inflation down. That's a dangerous conversation to have right now. But maybe change the metric that they look at and give us some clarity on that. That's the reason why people aren't emphasizing PCE as much as others would. Yeah, well, you already were talking about that.
Look, Chairman Powell, I think, addressed this in the past few years. Now's not a good time to do it because we've been persistently above target for so long. We've got to get our house in order before we start thinking about moving the goalpost. Moving the goalpost now would undermine the credibility of this institution, I think, even more in the eyes of many market participants.
Dear Gemini.
Or dear Claude.
Dear Claude, move the goalposts without moving the goalposts.
Yes.
Make it 40 minutes.
Don't make mistakes. You think it's going to be 40 minutes, this speech?
I do.
On Friday.
I think it's going to be 40 minutes talking about the framework and talking about the bigger goals at stake and what the potential task
I
force
hope it's not 40 minutes. My goodness.
What do you think?
I've got no time for that.
How long do you think
it's going to be? 10 minutes.
Really?
Right?
10 minutes of what?
Super short.
But then you actually have to say something.
He's got to say something. He agreed to the speech.
Yeah.
He didn't have to.
This is my reaction function.
He really didn't have to agree to the speech, by the way. I wouldn't have raised any questions about that at all.
That would have lent its own issues to markets. If he had said, I'm not going to give a speech, that would have told as much as him giving a speech and saying nothing. Arguably, him saying nothing and just talking in word salad is going to be potentially less pernicious to markets than him coming out or not giving a speech at all, or not even attending.
We'll see what we get in a few days' time.
Arugula.
2 days away. Equity futures right now in the S&P 500. With some balsamic?
Yeah, maybe.
Yeah, just about unchanged on the S&P. Word salad. In the bond market, 2s, 10s and 30s. Yields look like this at the moment. Stable at the long end. around 520. Coming up this hour, we'll catch up with Dan Skelly of Morgan Stanley on what's driving the bull case for equities. Tobin of Wolfe Research saying a Treasury intervention is unlikely to move the needle for yields. And Conrad DeQuadros of Citi Wealth looking ahead to a key round of inflation data. We begin this hour with stocks stalling as investors brace for a busy day on Wall Street. Dan Skelly of Morgan Stanley Wealth Management writing, we remain constructive on risk assets because fundamentals are strong. Financial conditions remain controlled. AI productivity evidence is emerging and valuations for the average stock are undemanding. Dan joins us now for more. Dan, good morning.
Good morning, John.
If it looks so good, why does it feel so bad?
Well, because I think
throughout the whole of August for so many people.
I think, to be fair, and we'll see who's actually tuning in on the last Friday in August to the big war speech coming up. But I think, to be fair, this is a period of time where liquidity conditions are waning, when people aren't as focused. And to be fair, stepping back, we have seen politics matter for this market in the last year or so. They've just mattered in the temporary sense. They've been the pop-up ads that we've discussed. So look, people are talking more and more about the midterms. We're getting more questions from our wealth management constituents related to, can the market actually act better in front of that catalyst? And I think those are the topics people are focused on.
When did the policy shocks become the movie and not just the pop-up ad?
Oh, so I think it's very much still the pop-up ad. The movie, which actually, interestingly, you guys did not talk about on the intro, is still AI. And we saw that really on display across what was a vicious rotation this past summer, out of semis into software. Now it looks like a little bit back out of software. But I think AI remains the main story for good reason.
Yeah, well, this is the reason why I think a lot of people are looking to Nvidia later today, not just when it comes to the outlook for chips, but also the financing of it and the appetite for it. How important will it be to get some details around the $500 billion memorandum of understanding that it signed, the $100 billion data center that it's planning to finance for OpenAI, all of these big numbers around the financing needs of these companies?
It's important. I think what Nvidia is going to try to strike is twofold. Number one, clearly an update in terms of the funding and how it's still relatively healthy, secure. Our credit team at Morgan Stanley actually just came out with a great in-depth view looking at Nvidia. And despite all of the different initiatives that they're undertaking, it's still a very clean balance sheet at like less than a turn of debt to EBITDA over the next several years. So I think they're going to strike a healthy tone on financing. But secondly, Lisa, they're obviously going to talk about the fundamentals. They're going to talk about the next product cycle. They're going to talk about compute demand still exceeding supply. And they're going to talk up their dominant market share, which, despite all of the challengers, is still the number one market share.
Do you think that this inflation is persistent and problematic for the broader economy? And I ask that with an eye toward Friday, the idea that Nvidia is going to talk about memory costs. It's going to talk about demand to the roof. And that's one of the biggest inputs for inflation that we've seen, except for oil prices. Is that something that has to be combated, that's actually starting to trickle down into consumer goods across the board?
It's a great take, and you're talking about the tech and AI supply chain. Let's zoom out and talk a little bit more about the consumer, because we heard from Walmart in the past 2 weeks that $4 gas prices did matter for their core constituent, and certainly that lower-end consumer who, candidly, has held up better than many would have perceived, I think, in the last couple of years. So the tech supply chain and the memory costs and some of the different issues there is going to remain top of mind. I think that having been said, we're also hearing about potential competition and emerging sources of cheaper memory, whether that be from China or other sources. And so the way our capitalism structure always works is these really well-regarded high-quality franchises are going to find alternative sources of inputs to try to make the profits work.
So where do you think the profits will be made? Where's the value being created? As you look across the whole AI ecosystem right now, increased competition into the hardware, that's what you're anticipating, it's what we're seeing. Where do you see the profits in the future, the value being created?
So per my opening comment that you alluded to in the intro, we're seeing increasing evidence. If you look at Michelle Weaver's work on the strategy side, increasing evidence within the Fortune 100 of AI adoption. So if I go back a year ago and you scrape all of the S&P transcripts from earnings season, no doubt using some tool from AI, of course, we saw something like 25% of S&P companies referencing direct productive uses of AI. Today, that number is 40%. The next phase of this, no doubt, and frankly, the phase that the earnings picture, which has been so strong of late, is dependent on going into 27, is when does that actually translate to explicit earnings guidance upside? We think that's coming in the next year or so.
Is there a particular industry where you see that concentrated in, or is it across the S&P?
So when you dig into the details, it's financials, it's healthcare, it's parts of manufacturing, and it's parts of consumer. So you see, interestingly, a lot of old economy sectors who are adopting and should see the most leverage in terms of the productivity gains.
You went there at using AI for your analyst reports. We've been talking a lot about the Stan Druckenmiller op-ed in the Wall Street Journal. Is there some sort of view in terms of when you can use AI, when you can't, how you have to disclose it internally? I know you might say no comment. Why are you asking me this on live television? But this is something that is increasingly a discussion as everybody grapples with authenticity, using tools that are important to use, but also trying to play by the rules and present themselves in the most honest way possible.
Sure, and I remember reading it myself thinking this has like harsh edges around it, which is always the sign of some type of intervention. So in our world, right, two things I would say is one is increasingly in analysis and research, as I just mentioned, on the strategy effort, it is a must-have. And secondly, in the wealth business, in terms of financial advice, in a world of AI proliferation, it makes the human interaction and the human judgment and understanding of a client's full picture even more important. And so, you know, look, there's different facets to how it cuts across our industry. We're using it, but we're also saying in the wealth business, the financial advisor and the sanctity around that trust and relationship is not going away.
Diplomatic. Dan, thank you. Dan Skelly there
Always.
of Morgan Stanley. You're basically asking a footballer, a professional footballer, to criticize Lionel Messi, right? It's Stan Druckenmiller. How many people on Wall Street do you think are going to come on the record, on TV, and criticize Druckenmiller?
Someone could say his sneakers
Right,
weren't that clean
Come on.
one game.
Just not going to happen.
I'm not even just about him, but more broadly, there is a real question about process, about where it should be used, about where you need to disclose that it's being used, about how much you need to check it and with the human engagement. These are all important questions that I think are being had.
I have more questions this morning for the Journal than I do for Druckenmiller.
I would agree with that.
Right, I think
this doesn't speak
it's
badly
their
about
problem,
him.
not his.
And
he doesn't seem to care at all.
And he was super transparent about it, and I respect that. The fact that he went out and was quoted in another story by the Wall Street Journal saying, yeah, that's right, that was artificial intelligence.
The line for me was, this is an invoice. When I saw that, that's not this is an invoice, or something like that. That was the tout for me. I read that, I was just like, oh, come on.
I thought that was creative. I have a lot of respect.
You thought it was a good line?
I thought that it was kind of an interesting way of saying it, you know, when prices go up.
Classic AI signature on that.
Either way, AI is actually very clever. It's just a matter of whether we need to demonstrate.
For the same reason I don't like LinkedIn right now. Well, it's just like a lot of AI slop through LinkedIn.
Is that what it is?
Oh, there's so much of it, Bramo. It's all the same.
Really?
Yeah,
Write something that makes me seem sensitive?
It reeks of it.
Make something that's sensitive, lesson learned.
What's interesting, though, is that there's a lot of slop on X as well, but the AI slop on X seemed to be more engaging than it is on LinkedIn.
Because it's shorter. You can go longer on LinkedIn. But I'm wondering what I would write. Make me something, a lesson learned that's not too bad, but that makes me feel approachable.
It's this sort of like lazy attempt to be sincere and on LinkedIn that I just
always take
can't get into.
Face value.
Anyway, let's give you an update on news worldwide this morning with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Iran and Oman in talks over an interim framework aimed at reopening shipping in the Strait of Hormuz. The deal would establish a temporary joint maritime corridor, and mine clearance would restore safe navigation through the area. The two nations are holding more talks to secure a more permanent route. Senator Darlene Graham defeating Congressman Ralph Norman in South Carolina's Republican primary runoff. Graham receiving the full backing of President Donald Trump to replace her late brother, Lindsey Graham, as the state's GOP candidate. She'll face the Democratic nominee, Annie Andrews, in November. OpenAI data center executive Chris Malone left the company last week, according to the Wall Street Journal. His exit joining a wave of leadership departures. This as OpenAI works towards an IPO expected in the next few months and races to catch up with rival Anthropic. That's your Bloomberg brief. John.
Hey, Vonnie, thank you. Thanks for the update. More from Vonnie in about 30 minutes' time. Up next on the programme, bracing for the Treasury's next move.
We are trying to bring the market back into equilibrium in a thinly traded market.
We haven't bought a single bond yet.
Up next, Tobin Marcus of Wolfe Research, live from New York City this morning. Good morning. It's a snoozy Wednesday in August. We need more of those, right? More snoozy summer days.
You're going to say
we haven't had money.
Okay, you're going to say that.
I said this last week, and then we got better intervention.
You literally are just jinxing it. You're going to create absolute wildness.
Kevin Walsh leaks ahead of the speech on Friday.
Kevin Walsh comes out
in the FT.
You're going to see me unplugged.
We're going to buy bonds too.
We're going to expand the balance sheet.
I'm not saying he's going to say that on Friday.
Heard it here first by Jonathan Ferro.
Nobody thinks he's going to do that on Friday. Equity futures right now unchanged on the S&P 500. The Goldberg's getting really excited. Nasdaq futures unchanged too. Likewise on the Russell. In the bond market, 2s, 10s and 30s shaping up as follows. Yields just about unchanged this morning. Higher at the front end by a couple of basis points. 419.70. Really anchored around 420. Even with a string of softer than expected data. I think that's notable heading into September.
A lot of Fed officials who have spoken since that FOMC meeting have said ultimately the string of softer data doesn't really indicate anything. One number doesn't mean much. They need to see a continuation of disinflation for this ultimately to matter. Again, the market's looking beyond what we've gotten so far.
A bit of stability in the bond market so far. Under surveillance this morning, bracing for the Treasury's next move.
We are trying to bring the market back into equilibrium in a thinly traded market. We were left with a mess.
We haven't bought a single bond yet. The next time we have an operation is September 9th. So we will see on September 9th.
We will see in a few weeks' time. Here's the latest this morning. Yields holding steady as Wall Street pushes back on Treasury Secretary Scott Bessent's bond buyback plan. Tobin Marcus of Wolfe Research writing the following. If the myth threat of action isn't enough to get yields down, we think Treasury will need to go very big on this program to have a meaningful impact. Tobin joins us now for more. Tobin, welcome. Obviously, the Treasury Secretary's been vague about the overall size of what this program might look like over the next several months. In fact, there was a leak more recently that maybe they'd use the general account. How much of the general account they use, I've got no idea. They could also just issue T-bills and go big, Tobin. How big is going big? How big do they need to go?
Yeah, so I don't think that the difference between using the general account or using new bill issuance as a financing mechanism makes much of a difference to the size of the program. They have the capacity to go big either way. In terms of scale, I mean, we look back at the Fed's Operation Twist in 2011, which of course is what this Treasury Twist label harkens back to. That was a $667 billion bond buying program, where the academic consensus, the academic literature consensus is that got you about 10 or 15 basis points on the 10-year. That's a factor of 8. Like to get to that scale, you need to increase this program at its currently announced scale by a factor of 8 and run it through the end of 2027. So it's quite a large expansion, and nothing that we've seen from Secretary Bessent suggests to me that he's prepared to go that big.
Tobin, is there a problem to go big on to begin with? Can we sit on that before we run away with ideas on how to challenge this? Long end of the curve, as you know, the 30-year piece of the Treasury curve, it's not a major piece of the curve that finances the US government. It's not a major piece of the curve that dictates borrowing costs across this economy either. You have to come in much closer to 10s and perhaps even shorter than that in many cases too. Tobin, why has this become such a hot issue for the Treasury?
Yeah, the 30-year itself is basically a driver of headlines. It's kind of a talking point. I completely agree that it's not really material for a lot of the actual real economy. Not much is anchored to it. I mean, these buybacks are across the entire 10 to 30-year spectrum, both the 10 to 20-year bucket and the 20 to 30. So, they're probably affecting the 10-year as well. There have been moves up across the curve, even though the 30-year has been the most dramatic. The 10-year also has been trading at levels that they're uncomfortable with, even if they're not quite as unprecedented within the past couple decades.
Tobin, I've been trying to gauge whether anyone in Washington, D.C. starts to say, wait a second, maybe this is our job to take up the deficit, or maybe we have to care about this. And then I remember what Warren Buffett said in 2011. He said, it's very easy to solve the problem of the deficit. He could do it in 5 minutes. You just pass a law that says anytime there's a deficit of more than 3% of GDP, all sitting members of Congress are ineligible for re-election. Is there any chance, given the political pressures and given the re-election cycle, that this Congress could actually take it up before prices go down significantly more and yields go up significantly more?
I would be very surprised. Secretary Bessent on last Thursday, promised that there would be a shortly forthcoming fiscal consolidation plan, which he indicated would be late that week, early this week. We, of course, have not seen any such thing. Whatever they do roll out, I think is very unlikely to make a difference in the deficit. He was kind of pitching it like Doge, but of course Doge already happened and did not meaningfully move the needle. So, I mean, ultimately, we're going to need bipartisan action on this in Congress. I think there's far too little sort of mutual goodwill and trust across the aisle to have any hope that people can hold hands and jump on that. But, you know, the optimistic story about this over the next few years is that we get into a point where deficit reduction is perceived by ordinary voters to have a benefit to them by virtue of bringing down interest rates. And that would be like the early 90s, where you know, the fiscal consolidation actually has some prospect of reducing consumer-facing interest rates like mortgage rates that I do think are one of the most salient elements of the affordability challenge. I don't think we're there yet, but, you know, fingers crossed, maybe we get some of that in 2028.
In the meantime, different administrations are going to have to try to make sure that yields stay below a certain level, just purely so interest expense doesn't go up too much to be overly punitive. I just wonder how international buyers will play into that, particularly governments, especially with some of the sanction regime that continues to be used as a tool. Do you see that being ongoing pressure, the idea that some of these big buyers of treasuries that are government and price insensitive are going to back away on the margins or at least not buy as much?
I don't worry that much about that. It's already been a significant secular shift away from the foreign official sector and towards more price-sensitive domestic buyers in terms of who the incremental buyer of treasuries is. So I think it's already the case that at the margin, it's somebody who cares about prices who's buying the incremental treasury. That's going to continue. I don't know that the scale of the sanctions regime that was rolled out on Monday is so dramatic that it's going to make anyone who's buying at scale today think about trying to exit the dollar system, even though that threat was made.
Tobin, it's good to see you. Thank you, sir. Tobin Marcus there of Wolfe Research on this backdrop for this debate right now. There was no crisis. To paraphrase the Druckenmiller piece in the Journal yesterday, this bond market hardly cleared his throat, and you had the Treasury Secretary stepping in. There are so many different fundamental reasons for yields to be at this level. The headline is really over the last week. There are many, but of course here's one. It's just how nervous the Treasury got over yields at this level with this backdrop and all these reasons, fundamental reasons for yields to be higher. And by the way, when I say fundamental reasons, I'm not just talking about the deficit. In fact, there are far more constructive reasons for yields to be at this levels in this economy, with 6% nominal GDP growth in America right now and risk appetite incredibly buoyant. Why wouldn't yields on treasuries be at the levels they're at right now?
Yeah, this is why the focus has been so much, though, on the deficit. The deficit isn't the driving factor for why yields are going up, but it is the reason why higher yields becomes overly punitive for the overall budget in the United States. And I think that that is what's different. And I think that's an important distinction to draw. The budget deficit is not driving yields here necessarily, but higher yields is driving the deficit further. Yep. And then it becomes that doom loop discussion that people have to talk about. So my question to Scott Bessent is, what is that level on long-term yields, or what is that level on average blended maturities for the U.S. Treasury Department where it becomes overly punitive, where suddenly you do enter that fiscal doom loop, where it becomes incredibly difficult to pass any agenda and pay for anything outside of just simply interest expense?
This is what makes the return to normal so unsustainable. When people come on the programme and say, we're going back to the old normal pre-GFC, this is where yields were in the 90s, the 2000s, it was sustainable then because debt to GDP ratios weren't what they are now. If the Treasury's nervous now, I think that tells you about something about how sustainable this might be going forward.
Yeah, and what this takes money away from. Think of what they can fund and what they can't fund. If a significant portion, bigger than the defense budget, is going to interest expense.
Let's talk about sports next. Up next, we'll catch up with Capital Investment CEO Mark Hine on the rapid pace of private capital firms piling into sports. That conversation up next. Live from New York City, welcome to the program. Equity futures right now in the S&P just about unchanged. We're negative by a tenth on the Nasdaq. In the bond market, 2s, 10s and 30s shaping up as follows. Yields stable at the long end, up by a single basis point at about 517. In the commodity market, a lot of attention on what's happening with crude, WTI and Brent. 3-day streak of lower prices. Brent crude at 86, WTI just at about 80 and negative by close to 3% on the session. There are talks between Oman and Iran about how to reopen the Strait of Hormuz and get volume up and traffic through that strait. This headline just crossing Bramo moments ago on that agreement, according to the IRGC.
Yeah, this says that Iran and Oman have agreed on sharing some of the Hormuz revenues. This is Iran's SEPA News, citing an IRGC spokesman. Interesting to think that Iran and Oman are going to be sharing Hormuz revenues, suggesting that there will be Hormuz revenues, which then gets to a question of, is it a toll? Is it a service fee? Is it acceptable to people in the region?
Is it acceptable to the United States and the president? And how do they weigh in on all of that? The encouraging sign of all of this, I think, is from Secretary Rubio saying that, ultimately indicating through Axios reporting today, suggesting that we're going to take the diplomatic path and not the kinetic phase and repeat that kinetic phase. But Lisa, I think the commodity market this morning reflects a situation where we're pricing out the potential for another harsh kinetic phase, as opposed to pricing in the potential for a deal. I hope we're closer to a deal than it seems we are, because if you're closer to a deal, you're closer to 70 and the 60s on crude than you are certainly to 80s and the 90s.
Yeah, and you're closer to reestablishing more normal commercial activities in the region and beyond, and it will help with a lot of different economies. There is an issue here, though, with exactly what this new normal looks like, and if people are just getting creative about getting new barrels out, as well as what happens in the interim in this sort of uneasy calm that is expected to take place.
86 right now, Brent. WTI at 80, 2 hours away from the cash open. Let's get you some morning movers, some single names. Yahara has more. Hey, Yahara.
Hi, John. We've gotten a few retailers reporting earnings this morning, and we start with Kohl's. Shares down nearly 4.7% in the pre-market, even after boosting its full-year EPS forecast. But the issue at the struggling retailer is still demand. Comparable sales fell about 1%, which was worse than analysts expected, while Kohl's also still sees little to no sales growth this year. It is getting a boost from tariffs, but investors want to see more people going into its stores and buying more. And it's a similar story over at Bath & Body Works. Those shares down 4% even after it raised its profit outlook. But sales at U.S. Canadian stores fell more than 5%, and it's expecting another sales decline this quarter. And remember, Bath & Body Works, they sell discretionary items, things like lotions and candles that consumers can really put off, especially when they're feeling the pinch, and it appears that is what they're doing here. And we end on software with Intuit shares. They are still plunging, down 11% in the pre-market after giving Wall Street a much weaker outlook than expected. TurboTax revenue is expected to grow just 2 to 3% this year, and Jefferies points out that would be the worst growth it's seen in more than a decade. John.
Yahara, thank you. With the update this morning on some single names for you. More from Yahara in the next hour. On our radar this morning, Secretary of State Marco Rubio reportedly signaling to allies that the U.S. is unlikely to initiate any new strikes against Iran. According to Axios, Washington is shifting its focus to economic pressure, including fresh sanctions. Elsewhere, the Richmond Fed President Tom Barkin warning rising U.S. debt could eventually trigger a, quote, reckoning. The total recently surpassing $40 trillion, Barkin adding that at some point people will stop buying the debt. And finally, OpenAI claiming a new processing chip called Jalapeno can outperform Nvidia's current lineup. The ChatGPT maker plans to deploy the semiconductor later this year to power its own AI models.
So I guess fast and hot, is that the idea of why they named it jalapeno? I mean,
Nice,
really,
Grandma.
I have to wonder
Nice.
exactly what they were thinking. Nonetheless, I will move on. This is going to be the subject of a lot of the discussion with Nvidia in terms of the competition. How much is that bringing down some of the prices for their own goods? How much is this pressuring them, given the fact that high prices and high memory input prices is prompting a whole lot of creation, whether it's at OpenAI or whether it's at the likes of Microsoft or Amazon, that we're seeing similar types of
And to
efforts.
some extent weighing on the multiple over at Nvidia already. We spoke to Sarah Kunst of Cleo Capital in the last hour, talking up the potential of a market pricing in deceleration for this company in the next few years.
Yeah, not only is the competition with price, but also with how far beyond these other competitors Nvidia's chips actually are. How do they maintain an edge? How do they consolidate a lot of the talent? OpenAI, of course, has been in a spotlight for not being able to retain talent. So again, talent war is heating up. If you want a big bonus boost and you work in this field, I assume you can
The money's crazy, right?
Just pouring in.
Have you
as their
seen
own.
the price of real estate around some of these companies? Like what you can get now? It's insane how expensive it is.
And then it's even more insane when you see that somebody hasn't even graduated college yet and they're able
Yes,
to buy
I know.
it.
Well, good for them.
Yeah, I agree, 100%.
I'm happy for them.
I'm happy for it too. If you want a place to stay and you want to be my friend,
yes,
let me know.
Well, let's talk about something less risky than investing in OpenAI, apparently. Private capital piling into sports, with at least 5 US professional teams striking deals to change ownership just this summer. Investors fueling record valuations, with more than $96 billion flowing to the asset class since 2018. Mark Hine is the CEO of Capital Investment Corp and has stakes in teams across the NFL, MLB and Premier League, telling Puck News recently, at today's valuations, there's meaningfully less downside risk in owning a piece of the Lakers than a piece of OpenAI. Mark, I'm pleased to say, joins us now for more. Mark, welcome to the programme. Quite a provocative quote, but I'm going to build on it and ask you this question, Mark. Do you think in some ways this is the one part of the entertainment industry that might well be insulated from what happens with AI?
For sure. First of all, it's great to be with you guys. And for sure, this is much more insulated from AI than most parts of the entertainment industry. Sports and music are the two things that bring us together at scale. AI is not going to change that. The drama and the excitement and the communal experience of coming together to watch your favorite team isn't going away. In fact, I would argue it's only going to grow as people have more time and more money. They're going to go and try to do stuff like this and have these kind of experiences.
Mark, let's talk about opportunities then for investment. I was reading through the transcript of that interview that you did with Puck News, and within that you reflected on that opportunity to get a franchise in Philadelphia, I believe, Mark, to get exposure to the NBA back then. Is there a similar opportunity that's available right now compared to the one that you passed up back then?
No, to invest in the 76ers at a $250 million valuation. No, I mean, look, back then, sports teams have always had a bit of being valued on the traditional business valuations, and a bit on intangible things, whether people wanted it because they love the sports or the experience, or because they viewed it as a store of value and uncorrelated assets. Always had that mix. What's happened over time is that the amount of the valuation that's now the intangible part, the uncorrelated part, the store of value, has grown so much. And that's why I don't know what the 76ers would be worth today, but it's at least 20 times as much. And in the major sports, you're not going to find that again.
Mark, a lot of people were decrying the Middle Eastern money that was going into soccer, in particular football, in Europe as distorting valuations so as to make it absolutely unaffordable to get involved if you are an investor, at least not attractive multiples. Do you see that kind of dynamic starting to happen in any other regions? Is that something that you are following closely?
Well, I mean, look, it is getting harder and harder for all kinds of people to be the majority owner of these teams. You see the prices. You showed the logos of the 5 trades in the U.S. But what's interesting is at the same time the prices are going up, what is driving a lot of it is actually a much more vibrant market for minority owner stakes, limited partner stakes in these teams, and the amount of capital that people are investing to take those minority stakes is growing. And so the headline price is going up. The majority owner ticket price is also going up. But a lot of the capital is actually coming from the people in the cap structure around the majority owner.
Do you have aspirations to become a control owner for any particular?
Well, I do own the tennis tournament in Washington that just ended, which really was my childhood dream. I was a ball kid at the tournament, and I'm fortunate enough that I do own that. And as you noted, I'm an investor in the Commanders and the Orioles and Leeds United, and I love that. I love both being the control owner in a big event that means a lot to me, but I also actually enjoy being a supportive minority owner in the other things.
Mark, can we talk about Premier League football? You mentioned Leeds United. I'm always fascinated by the American perspective on this. When you look at the franchise value of, say, the Seattle Seahawks at close to $10 billion, without any disrespect to these Seattle Seahawks, I think that we can sit here and safely say that on a global basis, Manchester United is a far more visible franchise. And yet, for some reason, these American franchises are able to generate that much more brand value and attract that much more money. And they seem to be valued at a higher level, a bigger premium, if you will, Mark, compared to English football, Mark. What explains that?
It's such a fascinating question. And actually, the other thing I would add is actually now, if you look at MLS franchises, some of them are more than Premier League teams. And you would say, well, how is that possible? It really comes down to two things. One is the economic model for European football teams is not that great. Even the ones that generate the most revenue don't generate very much at all of a bottom line. And so that's one. But the other huge one is relegation risk. And it's best shown when you compare a league like MLS that doesn't have relegation risk and you look at the ones that do. It's a huge discount because not only obviously the prestige drops if you get relegated, but you lose a massive amount of revenue at all. And when that happens, and so a huge amount of the difference, I think, is explained by actually relegation risk.
Can we pick up on that, Mark, and just apply it to, say, Leeds United? Leeds United is one of those clubs that always runs the risk of being relegated in the Premier League. It takes a lot of investment to stay up. You've managed to do that. Mark, does that affect and influence how you run the club compared to, say, how you'd run a franchise in America? And for those not in your world, can you give us examples?
Yeah, so first of all, I'm not in the control. I mean, the team is run terrifically well by a group of executives affiliated with actually the San Francisco 49ers. They do a great job, and I'm not in the weeds with them on that one, but we talk a lot, and I see it. And well, it does have a huge implication on how you run the team, because when you're relegated, you lose 200 million pounds of revenue over 2 years. And then when you come back in, you get that back. And so when you're in that zone, it's a lot harder to make to have long-term planning the way you do in an American traditional sports franchise, because you have this revenue uncertainty both ways. Now, we had a great season last year. We finished mid-table. We're feeling really good. Now you start to see how you can start to invest. And in fact, once we got promoted, we announced meaningful stadium expansion plan to Ellen Road, our home stadium, which you wouldn't have done while you were relegated. But when you get promoted and you believe you're going to stay up, then you get the revenue certainty that then actually lets you invest in all parts of the club, including the stadium.
Mark, since you're on the other side of this discussion, often on this show we'll talk about ticket prices, whether it's to the U.S. Open or whether it was to the World Cup. We'll say the prices are just too high. How do you balance the actual price of tickets versus the revenues that you get from other streams of advertising and beyond from just having the most eyeballs possible?
Yeah, and that's a great question. Obviously, it's a hot topic this week already because of the U.S. Open and some of the ticket prices there. Look, I view our ownership in these teams as caretakers for community assets. These teams or these events mean so much to so many people. I think you have a real obligation to finding ways to making them accessible for everyone in your community. And I think that there is a business part of it, that it's good business, but far beyond that, it really is part of your responsibility as the owner is to make sure that people can attend these events. And so you've got to find ways. Now, there's a lot of ways to it. Some sessions in a tennis tournament are less popular than others, so you can offer cheaper tickets. You can allocate tickets to certain groups. The challenge, and this is what happened at the U.S. Open, is with an incredibly liquid and easily transferable secondary market. If you sell tickets cheap to someone, it's very hard to regulate them not putting them back on the market and getting the market price. And that's a bit of what's going on here. Even the most well-intentioned owners who do this end up not able to accomplishing their goal because it's so easy these days once you get a ticket to resell it. So it's a challenge, but you saw the U.S. Open found a way to get 1,000 tickets in the hands of New Yorkers. We do similar things with the community our tennis tournament is in. We do the same thing with the Commanders. I really think it is part of your responsibility as an owner. The other thing I would say that I think happened this week at the U.S. Open and is happening is it's so easy to put tickets on the market that when your days or weeks out from an event, people will just put the ticket on the market with an aspirational price. Yeah. And so the headline looks really bad. The reality is, as the event gets closer, usually the prices come down. It's not as bad. But that headline of people going online and seeing these prices, I think, obviously upsets people.
Mark, we could talk to you all day. Let's do this again soon. In studio, hopefully.
Yeah.
Mark Hine, thank you, sir. The Capital Investment CEO on the price of franchises and the price of tickets right now.
Yeah, I mean, this has been a hot topic. And as he said, increasingly for the owners, those aspirational prices are really bad PR for what even the reality ends up being. And it's a great sort of whipping post for people who say the prices are just too high.
Without a doubt, I mean, they are too high. Premier League football, by the way, season tickets compared to American sports, super affordable.
Yeah, it's because of
if you saw the
relegation
prices.
risk. Yeah, it's relegation risk.
Right? It's that too. It's not really that.
It's just a different.
No, it's a different culture.
Yeah, and it's a different group of
In fact,
people.
it's really difficult to get season tickets. The waiting list is super, super long.
It's like the Green Bay Packers.
To get access.
Same thing.
Same thing?
Yeah, very much so. People, it's like lifers, then they pass it along to their
Right,
kids.
right. You sort of inherit it from
Yeah,
generation
exactly.
to generation, right. Let's give an update on news elsewhere this morning with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. IMF Managing Director Kristalina Georgieva saying AI investment is becoming a growth engine for the globe as countries ramp up data centre and infrastructure construction. Adding the global economy has weathered the Strait of Hormuz energy shock better than feared. Existing investors in Shein have agreed to a 6-month lockup on newly allocated shares in its Hong Kong trading debut. Sources telling us here at Bloomberg, current backers are expected to take up a significant portion of the offering, which could raise up to $1.8 billion. Meta and state attorneys general have discussed a possible mid-trial settlement in its teen social media case. Meta is accused of deliberately designing Facebook and Instagram to addict teens. A loss at trial could result in penalties of as much as $1.4 trillion for Meta. And that is your Bloomberg brief. John.
Vonnie, thank you. Thanks for the update. Up next on the programme, a test of credibility.
The Fed's inflation credibility, shockingly, after 6 years of missing the 2% target, is still very much intact. At some point, 6 years, 7 years, 8 years of missing it, the market's going to start to get nervous. And that is not reflected in longer bonds yet.
Up next, we'll catch up with Conrad DeQuadros of Citi Wealth, live from New York City. You're watching Bloomberg TV. Live from New York City, welcome to the programme. Under surveillance this morning, a test of credibility.
The Fed's inflation credibility, shockingly, after 6 years of missing the 2% target, is still very much intact. The Fed's inflation target, 2%. This is like hailing a cab in New York City. It's always coming at some point, 6 years, 7 years, 8 years of missing it, the market's going to start to get nervous. And that is not reflected in longer bonds yet.
So here's the latest this morning. PCE data due in less than 1 hour's time. Investors looking for the latest read on inflation ahead of Fed Chair Kevin Walsh's speech from Jackson Hole on Friday. Conrad DeQuadros of Citi writing inflation has moderated but remains above target. Firmer growth expectations allow central banks to keep their focus on price stability. We see this as supportive of higher policy rates globally. Conrad joins us now for more. Conrad, good morning.
Good morning.
Does that include the Fed?
I think it does. I mean, our view is, we don't think it's going to be imminent, but our view is that the next move from the Fed is likely to be a hike, not a cut. And the reason for that is that persistent inflation and the signs that their policymakers are becoming a little bit uncomfortable with the duration that inflation has been above their target. And so I think they do want to sort of reestablish that credibility. I would say that they didn't lose the credibility in markets, right? The markets do still look like they believe that the Fed will get the inflation backed out to target. But I think there's some nervousness that it's been too long. How can you seriously have a target if you're willing to tolerate
Lisa
it
mentioned
above?
this too, the loss of patience. I think it's important. Does that mean that the incoming information isn't as important as it was when it comes down to single decisions like, say, September?
Well, I think it might be the case that any single report has less relevance, but it does seem to be the case that the incoming reports taken together do provide information. So we heard from Susan Collins yesterday, for example, and she's clearly looking for signs of moderation in inflation in each of the upcoming reports. And if she doesn't see it, she too will start to support higher rates. And I think that was the messaging yesterday.
Which inflation metric matters? Do we understand what the Fed is actually looking at anymore?
Well, I think the hope is maybe we get some more information on that from Jackson Hole. Officially, the Fed is still looking most closely at that core PCE measure, but now we know that they want to take a bit of a broader view, and I don't think that that's a bad idea. We've heard about maybe some focus on the trim means. I think that there's some value in that. One of the things that we focused on is the breadth of inflation gains. So how many of the components of those inflation measures are rising at very rapid rates? I think that would be helpful information. So I think broadening out the inflation view would be useful. rather than just looking at one indicator. But obviously the one indicator that they're looking at right now is pretty elevated at 3.25%.
If you broaden your view, and this is something people have discussed, whether it's the AI inputs or some of the component prices that have gone up, where is inflation coming from, and is it something that warrants Fed action to counteract?
Well, that's a very good question, and I think that that's kind of the point of looking at these breadth measures, where it might be the case that AI-related inflation in chips that feed through into computers are pushing the prices higher, but if we strip out the tails of the distribution on prices and look at the middle of the distribution, I think that that's kind of a good way to get an indication is it just these one-off things, or is it more broad? So, we looked at the trim means. The trim means are still running at 2.75% on PCE. We look at those breadth measures. There's still a third of the components of the CPI will get PCE today, but of the CPI are rising above 5% one-month annualized rates. Before the pandemic, that was a quarter. So that's sort of one indication that we're not there yet, and it's not just one-off things. It is more broad.
You don't think a move is imminent, so that takes September off the table, fair?
I think so. I think September.
When does it become real for them, and what makes it real?
So I think by the end of the year, if there's not evidence that the inflation data are getting better and we are seeing some tamping down and maybe some signs that they are making progress towards the more broadly defined price stability target, I think that puts December in play, or maybe early next year. And I do think that it depends on the data. But by the time we get to December, I think there are Fed officials. There's already 3 who think they should be hiking now. We only have to get to 7 for there to be a hike. And there's a lot of focus on Kevin Warsh, but it's a committee decision. And if you were to get those next few inflation reports, and we don't have calls for any specific meeting, but we do need to see that progress in the next few meetings for them to continue to hold off.
Is there too much focus on Kevin Warsh?
I think there is. Look, it's not a surprise that he's the Fed chair. But for example, all the talk about has the Fed lost credibility because of the last meeting. My question is, Kevin Warsh has been there for 3 months. The Fed has missed its inflation target for almost 6 years.
Yep.
Isn't that the credibility issue? Now, I think that it is important to focus on Kevin Warsh because he's the leader and he directs the Fed, and he's making some changes, shifts in direction in very important ways. They're looking at the balance sheet. They're looking at the inflation measures. They're looking at the conduct of monetary policy. These are important things, but again, they're not going to signal any imminent change in the direction of the Fed. These task forces are going to report at the end of the year. There'll be potential changes next year, but again, it's the committee that will decide those potential changes, not Kevin Warsh on his own.
Conrad, it's good to see you. Thank you, sir. Conrad DeQuadros there of Citi Wealth. He didn't say it. I'm going to say it for him. The Powell Fed was given a free pass, wasn't it? For quite a while by a lot of people.
And now people are looking at it in a different way. Interesting
Yes.
that we haven't heard from the other governors, though. We've heard from other Fed officials, but not the governors.
The third hour of Bloomberg Surveillance just around the corner.
The AI story is so dominant, it is the driving factor throughout markets.
We're starting to see a lot of investor nervousness.
The market wants to see real evidence that the spending is it's getting return. It's turning into margins, turning into profits, turning into free cash flow.
This build-out is not as mature as people think.
The volatility in certain segments in tech has been so dramatic. It's a bad Ouija board at this point.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The third hour of Bloomberg Surveillance starts right now, and your price action of scores look like this. Pulling back by just a tenth on the S&P 500, on the Nasdaq down by 0.2. The main event for the Nasdaq later this afternoon, it's Nvidia after the closing bell. Nvidia snapping a 7-day losing streak in yesterday's session. That was the longest daily losing run going back to September 2022. This morning, just about unchanged. Switch up the board and get to the bond market. 2s, 10s and 30s at the long end of the curve on the month so far. Yields lower at the long end by some 10 basis points. This morning higher by a single basis point to 5.17. At the front end, stable, up by a basis point, 4.18. Heading into data later, crude has helped this move in bonds. It's introduced just a little bit of stability. We're down 2% on WTI. Brent crude is down by 2.3. Brent this morning at 86. WTI briefly early this morning trading in the 70s. The main event for us all, I mentioned Nvidia after the closing bell. Before we get there at 8:30 Eastern Time, 29 minutes from now, it's a read on PCE. And Bramo, I'm right there with you. Typically, this would be a big deal. Inflation data, it matters to the Fed. It's a big, important gauge. Overwhelmingly, the focus is on the man himself, Kevin Warsh, how he interprets the data and whether he'll even share his interpretation with us in a few days' time.
And what oil prices are doing more than PCE, which is supposed to be more independent of some of the volatility in commodity prices, just simply because when we have heard from Fed officials, and we keep going back to the Susan Collins speech yesterday, the Boston Fed, it doesn't seem to matter that disinflation has gotten into the data over the past couple of weeks because people think it's, dare I say it, transitory, given the fact that oil prices have been swinging around and do seem to bleed into it. As she was saying, that less benign scenarios are quite plausible. However, some of the recent data are mildly encouraging, but can be volatile and aren't enough for her to shift away from an otherwise hawkish position where she is more inclined to hike rates than to remain on hold.
It's a little bit controversial, but let's tackle this head on. Conrad talked about it. Everyone's going after Kevin Warsh. I'm not here to defend him. I thought the news conference was really sloppy. It's only been there for a few months. There's another guy who's been running the Federal Reserve for a long, long time, and they've been above target for 5+ years. And everyone seems to be going after the Warsh Fed without very little thinking on what happened previously under the Powell Fed. And it was also on the committee. There are some individuals that didn't seem too concerned about being above target for so long, and now all of a sudden they've lost patience. Where's that loss of patience come from? Just time? Or was it a change of leadership and a lack of faith in the man running the institution right now?
I think it's a really important question, and a lot of the communication that we have heard from different Fed officials has given us very different reaction functions and what they're looking for. You're right. How much is qualitative and how much is quantitative? How much is there some sort of guide, or how much is everybody operating in a vacuum where emotion can play a bigger role in sort of coloring the data and coloring the trend? I would be curious to understand the components of inflation that matter, how the acceleration is being viewed, and whether that is truly the calculus of people who are getting impatient now, or whether it is just we don't have conviction that this person's willing to combat it the way that the previous regime.
I get that we don't have an understanding of his personal reaction function. I understand that. But I think we do have an understanding of the Federal Reserve's reaction function, the committees in totality, given the way we've priced September off the back of weaker than expected data. Saying that we don't know what the reaction function is and saying that we think the reaction function is too dovish, I think are two very different things, aren't they, going into September?
There were questions about why he couldn't answer the question about his preferred tool for bringing down inflation, whether interest rates were the main tool or whether potentially the balance sheet and some other tools could otherwise. These are the types of things that people point to, but you're right, which is that the tone has shifted on the FOMC. A question about the committee members who had been pretty patient earlier this year. What has shifted for them so materially? Is it AI? Is it persistent tensions that are leading to oil prices and commodity prices to go higher? Is it something else that they're seeing in the labor market that they didn't see last year? This is all important, and this is the reason why I am so excited to be going out to Wyoming to discuss all of these things against the backdrop of glacial mountains.
It's beautiful.
It is beautiful.
It is beautiful.
But very cold in the morning, so feel bad for me.
I won't be jealous first thing in the morning because it is very cold. I'll be envious as the day progresses. We start to see that shot come into view, the sun starts to come up.
Beautiful.
It's gorgeous.
Buffalo,
it's beautiful.
Actually, bison, excuse me.
You going on any hikes this year?
Of course.
Okay.
Come on. I'll bring bear spray, don't worry.
Good.
I'll come back without any bear maulings.
Bramo sees cubs and gravitates to them. And I've spent years warning Bramo that you shouldn't do that. You need to rewire, and when you see cubs,
they're
move
cute.
away.
Bears, there's a reason why there's a teddy bear. There's a reason why
They're
we have
super
made
cute.
it into. I know that you think that we've all just been conditioned to think that they're cute.
I think that you've been conditioned to think that real-life bear cubs are cute.
Because I've actually seen them and they're adorable.
And you're not scared of Mama Bear.
I'm definitely scared of Mama Bear.
Terrified.
I'm not going over there and hugging baby bear.
I should hope not.
I will just say it's really fun to see animals in the wild, and let me tell you, they're really interesting.
Okay, stay safe.
I will.
Looking forward to the programme, 9 a.m. Eastern Time on Friday, alongside TK and the team breaking down that speech from Fed Chair Kevin Warsh. Coming up this hour, we'll catch up with Tracie McMillion of Wells Fargo on why she's sticking with stocks over bonds. Jay Goldberg of Seaport counting down to Nvidia earnings, and Stephanie Roth of Wolfe Research breaking down the latest PCE report. We begin this hour with stocks steady as investors brace for Nvidia results and a fresh read on inflation. Tracie McMillion of Wells Fargo writing, look through headline volatility to overweight equities over fixed income, given strong earnings. Tracie joins us now for more. Tracie, two core calls from you and the team, and welcome to the show. One was a steeper yield curve at the start of the year, and the other was to get long financials. Financials have ripped, with the exception of last week, an 11-week winning run for that sector on the S&P. Fantastic run. On a steeper curve, the Treasury Secretary, Scott Bessent, Tracie, now has other ideas, and I wonder whether that's upending your view to some extent on the bond market.
Good morning, John. So to answer your question, not really upending our view on the bond market. We have seen that steeper yield curve as we predicted, and we've really seen it rising on the longer end. And, you know, that was our forecast at the beginning of the year. It's what we forecast for 27. We think that we have more room to move higher. And we think that because we think that the intervention that the Secretary Bessent described last week is not addressing the underlying issues. And the main underlying issue is that we have a lot of supply coming to market. So it's no longer just the Treasury issuing bonds. We now have companies that we're paying through cash flow, turning to the credit markets to fund the AI infrastructure build out, and that's important.
Tracie, is there a moment where it flips, where the issues that you see developing in bonds become a problem for the profit cycle funded by the debt raising that we've seen by the hyperscalers? Is there an issue in debt that becomes an issue for equity?
At some point, it probably will. We haven't reached that point yet because earnings have been so strong. And if you're a corporation and you're looking out at 10, 15, 20, 30% earnings growth, then a 5, 6, 7% interest rate is still very appealing to you. Those interest rates have risen, yes, but we've got very strong nominal GDP supporting those higher interest rates and very strong earnings, driving companies toward issuing more credit.
We have seen in the equity space people move away from some of the high flyers of the past few years. Nvidia is a perfect example, reporting earnings after the bell. You've seen their shares really underperform some of the other broader indices, up about 15% so far this year, but a very long streak of losses. I just wonder if you think that indicates that some of the biggest momentum trades kind of have seen their big gains and kind of aren't going to drive the returns that we're going to see in equities going forward.
So we think that they do continue to drive a lot of the earnings going forward. Yes, we've seen big gains, but we think that the AI story is more of a secular story. So we are still overweight information technology, and we're overweight communication services and materials, which are more ancillary AI plays at lower valuations. And we think that those earnings are really going to drive prices higher by the end of next year.
Tracie McMillion with the latest over at Wells Fargo. Tracie, thank you. Appreciate it. For those of you tracking this story, I'm sure many of you are, the controversy around Mark Walters and TWG and its affiliated companies, the loans provided from some of the insurance companies that were directed into investments affiliated with Mark Walters without being properly disclosed. That's the investigation for the federal authorities and the SEC. There is a statement that's just dropped just moments ago. I'll share it with you. It comes from TWG Global. There are a number of bullet points here, so I'm working through the press release in real time. It goes on to say, despite what has been reported, there has been no fraud. TWG and Group 1001 insurance companies have presented a plan to address any regulatory concerns. It goes on to read, affiliated transactions are common across the insurance industry, and suggesting that TWG is looting insurers is defamatory and false. TWG is not looking to sell its sports assets at fire sale prices to raise capital for its insurance operations. The allegations that the LA Dodgers were acquired or have been funded improperly is false and not supported by the facts. A number of paragraphs that back up those statements from TWG released just moments ago.
Yeah, including that the Lakers sale at $12.5 billion was sold at a 25% premium, not exactly a fire sale. Really continuing to emphasize that they are working with the Department of Justice and the SEC to resolve the inquiries, and that they and Guggenheim have done no wrongdoing. They also said, and you mentioned this, that insurer looting claims are defamatory and false. So this is a clear effort to try to combat some of the stories that keep coming out about different allegations tied to this company.
Their direct response in that press release just in the last few minutes or so. Let's give you an update on news elsewhere. Let's get to your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. The IRGC saying Iran and Oman have agreed on a share of revenues in the Strait of Hormuz. The two nations are working towards a temporary joint maritime corridor through the critical waterway and are expected to hold more talks to secure a more permanent route. Richmond Fed President Tom Marvin issuing a warning that rising U.S. debt could eventually trigger a, quote, reckoning. With a total recently surpassing $40 trillion, Marvin cautioned that at some point people will stop buying debt, though he says that timing remains uncertain. Abercrombie & Fitch higher in the pre-market. The retailer raised its full-year 2027 outlook, driven by strong second-quarter results. CEO Fran Horowitz seeing well-balanced growth across all brands and regions. And that is your Bloomberg Brief. John.
Vonnie, thank you. More from Vonnie in about 30 minutes' time. Up next, the morning calls. Plus, Jay Goldberg of Seaport counting down to earnings from Nvidia, dropping after the closing bell, with equity futures on the S&P 500 just about unchanged, negative by not even 0.1%. Live from New York City this morning. Good morning.
AI remains the main story for good reason. The next phase of this, no doubt, and frankly the phase that the earnings picture, which has been so strong of late, is dependent on going into 27, is when does that actually translate to explicit earnings guidance upside? We think that's coming in the next year or so.
Was Dan Skelly of Morgan Stanley weighing in on the profit cycle, an unreal profit cycle so far this year. Just think about where things were. We came into this quarter looking for 20% earnings growth, which is a really punchy number, right? Ended up being closer to 30, which is ridiculous. Outside of recessions and recoveries, you do not see numbers like that on the S&P 500. That's exactly what we've seen in Q2.
And some are saying, is this as good as it gets? Can you continue with this type of acceleration? And if you can't, is there enough heat in the system to maintain the earnings, maintain the multiple expansion that we've seen for a lot of these companies? It depends what sector you're in, and frankly, a lot of people have said absolutely yes, the answer is, especially because there are certain efficiencies that tied to AI that the adopters are really seeing come through.
By the time you get to Nvidia earnings, it feels like you've been doing earnings season for years, and it feels like we've been covering this earnings season for years.
Kind of have.
JP Morgan feels like decades ago. Remember bank earnings?
JP Morgan's around the corner. It's going to start again in about a week.
A few weeks' time.
Like we already got to like a full cycle. I do think it's going to be really telling, though, about financing and also the look ahead for semiconductors that have really gotten beaten up. They've had a rough ride of it so far.
Ed's going to join us in a moment. It's the politics for me.
Yeah.
The politics is becoming a real business issue. Sarah Kunst said it. You need to be able to build data centers to put the things in that Nvidia sells. And right now, there are a lot of politicians in this country who do not want data centers in their backyard.
Yeah, but what's he going to say? I think there should be data centers, and we'll make it more in your interest to have that in your backyard. And guess what? We have a big bank account for lobbyists down in Washington, D.C. to talk about all of this with all of your friendly constituents. Look, this to me is going to be an interesting thing going forward. How much is he actually going to say about it?
Nasdaq futures this morning, negative by about 1/3%. On the S&P, we're down by 1/10. That's the price action. Let's get you some morning calls. First up, Bank of America downgrading Intuit to neutral, highlighting market share loss to AI-based alternatives. That name is down by 9%. Your second call from Citi, raising its price target on Snowflake, citing momentum and increased migration across financial services. And finally, UBS raising its price target on Dow, noting stronger server and storage demand in the near term. That's the story. And three stocks to watch this morning. Here's another. Nvidia reporting earnings after the closing bell as tension continues to build for the AI story.
There is muted enthusiasm. There's also just larger secular trends. People are not liking data centers. And if data centers can't be built, then where do all these Nvidia chips go? Nvidia can have the best chips in the world. They largely do. It doesn't matter if no one's buying them.
The chipmaker coming off its longest losing streak since 2022, going into earnings later this afternoon. On top of those earnings, Bloomberg's Ed Ludlow. Good morning, Ed.
Yeah, good morning, John. The expectation is sales of $92.3 billion in the quarter and EPS of $2.09, both double what they were a year ago. But having risen 2% or more yesterday and snapping a 7-day run of declines, matching the streak that we saw just before the ChatGPT moment of 2022, everyone has started to talk more about the decelerating growth of future years and quarters. Data center is still everything. And from the technology perspective, Nvidia is in a moment where it is trying to convince Wall Street that as it transitions from one generation of platform, Blackwell, to another, Vera Rubin, that's now in full production, but it will bring a new wave of acceleration. We are very close to the midterms in a world where we have tangible data that, yes, Americans' attitudes towards data centers is putting some projects on hold, delaying others. Others are being cancelled outright. And it is NVIDIA GPUs that largely go into those. The high bar is set very simply against the guide for the third quarter, the current period, where Wall Street expects them to say they'll hit sales of $105 billion. That is a very high bar. And right now, you know, the probably backdrop is Jensen Huang is balancing shareholder returns and shareholder-friendly policies. Buybacks and dividends are expected to be on the table, but explain the circular financing story because it hasn't gone away and it's likely to be put to him directly.
So many dimensions here, Ed. There's also a wave of competition too. From your perspective, you track this technology far closer than I do. How material is that competition?
Yeah, I mean, there is certainly a school of thought that the reason that the stock now, on a year-to-date performance basis or on a forward PE basis, trades much more in line with the S&P 500 is an acknowledgement that that competition is coming. That's why people have sort of recalibrated their future growth forecasts. The other side of the coin, or the counter-argument, is the reason that all of the frontier labs are doing their own chips. We had OpenAI put performance metrics out on their chip yesterday. The hyperscalers are buying from NVIDIA, AMD, TPUs from Google, is that the environment is still the same. Massive compute constraints, supply is constrained, falling behind demand, and future demand as well. And to be honest, until NVIDIA stops posting the gross levels that they've shown, it's very hard to argue that they are losing or ceding market share to that competition.
Ed, it's good to see you. Thank you, buddy. Looking forward to the coverage later on this afternoon. Bloomberg's Ed Ludlow on top of that blockbuster earnings story. Jay Goldberg of Seaport holding the only sell rating on NVIDIA. Price target 180. Jay joins us now for more. Jay, welcome. Is there some deceleration on the horizon?
I think that's likely, right? I think this quarter will be good. Maybe the guide will be okay. But I think it's just getting harder and harder for NVIDIA to compete and to sell. Not forecasting disaster, but it's getting harder.
We're getting closer to your price target of 180. You actually have been right with respect to the performance relative to the rest of the markets, although you are seeing NVIDIA shares up so far this year, but much more muted than in the past. What would it take for you to put a neutral rating or even a buy?
I think the key issue for NVIDIA right now is that they're selling everything they can, right? They've got all the allocation they can from TSMC. They've locked down allocation to all these other companies. They're sold out, right? And how do you deliver surprise upside beyond that? It's very, very hard for them. There's a lot more that can go wrong here than can go right. Ed was just talking about data center pushback. There's supply chain issues. You just go down the list of things that could go wrong here that could not wreck them, but certainly deter their record, sort of put a dent in things. It seems pretty likely that next year starts getting tougher. And then you add on to that all the competition that's out there, plus the surge in memory prices. All of those sort of can play into the margins and profitability that NVIDIA has.
At what point does NVIDIA get treated like a venture capital firm as much as a chip maker, given how much money it's put into the entire ecosystem of artificial intelligence? It seems like it has as big of a portfolio as many other businesses just sort of hanging out there that people don't consider. How does it factor in for you?
For me, I look at it as NVIDIA is constantly advancing the terms of competition, right? First, they sold chips, then they sold servers, then they differentiated with software. They've had all those things working for them, but that's getting harder and harder as AMD and Google TPUs start to catch up, right? So now they're also competing in networking and supply chain, locking down the supply chain and using their balance sheet as a competitive tool. And that's good while it lasts. They certainly have the sort of headline name. They can attract lots of people to their cause. but they're now competing with financial engineering, which is much harder for them to differentiate.
Jay, what's the difference between fostering healthy growth in the ecosystem and a kind of more sinister circular finance that you'd be concerned about?
I think that the distinction is, if you go back to like the .com era, when you had companies that monetized through advertising, and they'd sell company A would sell advertising to company B, and then company B would pay them in advertising slots on their site, right? And so it was literally trading revenue back and forth. NVIDIA's not quite there yet. I think there's a fine line between enabling demand and creating that demand. And NVIDIA's getting ever closer to that point.
Jay, before you go, just on the politics, Ed mentioned it, the midterms, the pushback you're seeing against data center growth in this country. Is it too early to expect that to start to influence the outlook for growth?
I think so. Most of what's in store for this year, what they're going to talk about in sort of near term and earnings and guidance, that's all set in stone. That's stuff that's already in construction. That's not the issue. I think it starts to become a more prominent issue next year when data centers that we had sort of penciled in for being built don't get built or just get delayed significantly. So I think that's a sort of next year would see the impact of that.
Interesting, Jay. Thank you, buddy. Appreciate it. Jay Goldberg there of Seaport. On Nvidia, there are 79 buys on Nvidia. There are 2 holds. There is 1 sell. That 1 sell belongs to that guy right there.
Yeah, and look, we have seen the shares gain value so far this year, but they've been underperforming what a lot of people had expected. And certainly on a multiple level, you've seen huge multiple compression. So you've definitely seen people take some chips off the table, if you will, when it comes to Nvidia.
Nice, Bramo.
Anytime.
Is that ChatGPT? No, that's just authentic. That's just real.
That's sad. Actually, I'd like it to be artificial intelligence.
In the moment. That's where the value is, Bramo.
Maybe sometimes,
journalism.
I wasn't A+ in aphorisms or sayings, so maybe, I'm using AI to help with, making it a little bit
Comes
better.
From a good place.
Does it?
Of course it does. Up next, we'll get you some data. Breaking PCE data just around the corner. Stephanie Roth of Wolfe Research joins us to react. We often call this the Fed's preferred gauge. The question is, for how long? That conversation up next. The latest read on inflation just seconds away, about 20 seconds away to be precise. Equity futures heading into that. Your scores look like this, just about positive on the S&P, slightly negative on the Nasdaq. In the bond market, 2s, 10s and 30s. On the month, yields a lot lower at the long end of the curve, 516 now at the very long end. We've come in over this month so far, down about 10 basis points or so on a 30-year bond. At the front end, the 2-year at 417. With your economic data, Mike McKee has more. Good morning, Mike.
Good morning, John. We've got a lot of numbers this morning, but the first ones out are durable goods, so I'll give you that very quickly. Up 1.1%, more than double the analysts' expectations. Okay, here's the numbers that mattered to everybody this morning, and that's the PCE price indexes. The headline up 0.2%. That is more than the 1/10 expected. It was down 1/10 in the month of June. The year-over-year number is 3.7%, unchanged from what we saw in June. The core at 0.2% is as expected, and the year-over-year number stays at 3.3%. So a slightly higher inflation number on the headline, which is probably due to the switch in the energy numbers over the month. And whether that matters a lot to the Fed at this point is something we're going to learn in the next couple of hours or days. Personal income is up 0.4%. That's double what it was in the last month in June and double what was expected. Personal spending up 0.2%, less than the 0.3 last month, but double what was expected. So a strong economy and still some inflation would tend to have you lean towards maybe increasing the odds of a Fed rate increase. As I mentioned, durable goods orders were up 1.1%, and capital goods orders were up 0.2%. They'd been up 1 1.7% now revised in the month of June. So huge capital orders. That's likely all AI related, but only up 0.2 in the month of July. And GDP unchanged. The second reading of GDP for the second quarter, 1.5%. Personal consumption a little bit stronger, 3.4% from 3.2%. So a little bit stronger economy is the bottom line here, and a little bit, tiny little bit inflation move based on energy. And at this point, what we could say is that it has become steady. It hasn't changed a whole lot, the inflation picture. So we'll see what Kevin Warsh and colleagues have to say about that when they get here in Jackson Hole. And I did want to show you my hotel room this morning, John, because it's
what
not
have we got,
the same
Mike?
as the other day.
Have you moved?
We have moved. We are at Jackson Lake Lodge, and we are awaiting the arrival of all of the members of the Open Market Committee and other Fed and central bankers from around the world.
Mike McKee, stay close, Mike. I'll have a look in just a moment. I want to look at the markets first. Equity futures on the S&P 500 negative by 0.1. The Nasdaq down by 1/3. This move at the front end of the curve. Yields a little bit higher on twos by about 2 basis points. Call it 3. Back to 420 on twos. A small move in the grand scheme of things, but a stronger economy and a slightly hotter economy. If you look at the strength, personal income better than expected, personal spending better than expected. And as for the heat, PCE coming in just a bit firmer than anticipated, Bramo, on the headline.
Yeah, 3.7% year over year versus the expected 3.6%. I do find this mix interesting, and I actually find the response into your yields also notable. It took some time for people to start pricing in a greater chance of a rate hike. And as people digested it, the more that they digest it, the more front-end yields are rising. I just wonder whether people are a little gun shy, looking at data and drawing too many conclusions right now, just because it has been something that people have moved past. But it seems as people look at this, they do think that on the balance, this does make people more hawkish going into the
Starting points matter. Are you looking for data to get you to hike or to stop you from hiking?
Stop you from hiking.
Right, and I think that's different. The bias has changed somewhat for some individuals on this committee.
This is really the onus on disinflation to actually show itself rather than some sort of change in the status quo. The status quo is not good enough anymore, and that is what we've heard from one person after another. So when you have status quo and you have inflation running at the same pace, it is just one number, but it will put some people, at least, definitely in the camp of hiking rates.
Mike McKee still with us. Mike, come back into the conversation. Set the bar, set the stage for us in a few days' time. What kind of speech are you anticipating from the Fed Chair, Kevin Warsh?
Well, we were discussing this last night with some of the other Fed officials who aren't on the committee, who've arrived here. And there does seem to be a lot of pressure on Kevin Warsh from Wall Street to do something to explain how they're going to bring down inflation. He's promised to do it, but right now it's not moving. It's basically where it was before the Iran war started. And a lot of members of the committee were not happy with inflation where it was then because it hadn't moved down in 5 years. So will he go that far to explain, to do a little bit more about whether the Fed will use the interest rate tool at some point if necessary, or will he stick to high-level generalities? The interesting numbers today may be more in the income and spending numbers because they're stronger than anticipated, and also the durable goods orders numbers because they were stronger than anticipated. And so the economy is relatively strong at this point. You don't see any weakening that would cause them to worry about raising rates at this point. Now, we still have more CPI to go on the 12th of September, and that'll be really definitive. Let me just note that wages and salaries went up 0.3 in the month of July. That was up from 0.1 the month before. So wages and salaries pick up. Personal spending was a little bit slower, but disposable income a lot higher, up 0.5%. And the savings rate, 2.7%, is basically unchanged. So what we're looking at is, again, relatively strong economy with inflation pressures and no real sign that they're moving down.
Mike McKee, on location, ready to go. Kevin Warsh speech a few days away. Mike, appreciate it. Thank you, sir, as always. One more payrolls report on the 4th. A week later, a CPI print. Stephanie Roth of Wolfe Research joins us now for more. Stephanie, good morning.
Good morning.
Have you seen enough to stop this Fed from hiking in September?
Yes, I think so. I mean, barely so, but I think so. I mean, today's core PCE just barely rounded down to 0.2. It's 0.2455, so we almost got a 0.3, which would have potentially rattled markets just to some extent as everybody sees their Bloomberg screen. I think we're in an environment where the data will look a little bit cooler in the next couple of prints, such that the Fed can avoid hiking and do it credibly. So we're going to see, another round of inflation data. That will probably come in on the softer side. The seasonals are in our favor. The Fed officials all know that at the end of September, we're going to get some revisions to how they're calculating PCE. In today's print, portfolio management was up 5.6%. That is a piece of the inflation data that's going to change in a couple of weeks. Therefore, it might bring some downward pressure to the data. So overall, we're likely to see an environment where the labor market data look a little bit softer from here, and the inflation data also cools such that they can just sort of wait and see, and therefore they don't ultimately have to hike.
Are you looking for a wait-and-see speech on Friday?
Yeah, I think he's not going to say a whole lot. I mean, granted, of course, it's not Q&A, which is what tends to sort of create some market volatility. He'll probably correct some of the points that the market didn't like last time. He'll probably talk about, 2% is for sure the inflation target. We're not looking at changing the inflation measures, at least at this point. He'll correct the reasons as to why they did not end up hiking in July. They were probably looking for softer inflation data. And then outside of that, I don't think we're going to hear a whole lot.
Do you think that the emphasis still will be on remaining on hold, that otherwise this would be a Fed that would be desiring to hike rates? In other words, are we going to see the hawks still dominate the discussion, even with a non-speech from Kevin Warsh and this sort of assumption that he's going to try to remain on hold as long as possible?
I think to some extent, but the data have very much been in their favor. I mean, if you look at the last 2 months, we've had 2 consecutive months of softer inflation data. We've had employment data that's mixed, if not somewhat concerning to some extent on the headline level. In the next print, we'll probably see a bit of a tick up in the unemployment rate, with payrolls running at an okay pace. So they're not really going to be in the same urgency to hike that they felt in July. And we're in an environment where wage inflation is pretty sluggish, and therefore it's not feeding into inflation.
Are we just justifying why we're reacting so strongly to oil prices? I mean, essentially, is this a bond market that's being dictated by oil, and people are running around fanatically saying, it's not just oil, it's all these other things. Then oil prices go down, and it's like, oh, well, look at this, it's inflation, and oil helps.
To some extent, I think you're right. I mean, I was surprised the extent to which yields didn't reflect the softer inflation data that we've seen, because the data couldn't have been cooler for the most part in the last couple of months, yet yields continued to back up. And, of course, people talk about supply and the deficit and all these dynamics that haven't really changed in the last couple of months, yet you see yields continue to back up. So certainly we saw the moves yesterday seem to be oil related. I think it's a combination of things. When people wake up after Labor Day, we'll probably be in an environment where the data comes more into focus, then focus on a Fed that's not likely to hike, and therefore yields can come down a bit.
Where is inflation the most problematic? Take out oil prices that are somewhat volatile. I know it's difficult because it impedes in a lot of different areas. Is AI-related inflation problematic? Are we seeing inflation in other areas that suggests that it's becoming more pervasive in the psychology and in commerce?
So when we think about the reasons as to why core inflation has been elevated this year, I would say it's 3 things. It's been the Iran war, which at this point we're kind of seeing a bouncing around in oil, but kind of somewhat stable at this point. It's been tariffs, which are going to be rolling off the data. And you're starting to see some companies come out and say they're using some tariff refunds to offset some prices.
Notwithstanding Canada.
Fair. And then the big thing has been the chips. So I think by far the biggest thing we should be watching is on the AI-related inflation, because that's the piece that hasn't fully worked its way through the data at this point. We think for the most part, we've seen the impact flow through into computers and accessories and that type of thing. But it's possible there's another piece of the AI puzzle that pops up in the inflation data that we're not necessarily aware of at this point. This is the part that could be, still adding some inflationary pressure. The other 2 factors are very much moving into disinflationary territory looking ahead.
I just saw a headline from Bath & Body Works. They saw approximately $80 million in 2Q tariff refunds. So many of those companies got money back. How different would this conversation have been? We were this close to 0.3. You said it. How different would this conversation have been if we did get a 0.3?
Funny enough, it's fractions of a basis point here. I think the conversation would be different.
Isn't that really silly?
Completely, no question. But it's just this mental model, and you see, you look on your Bloomberg screen, which is rounded to 1 decimal, and it's 0.2, so we can all breathe a sigh of relief. But you're right. I think we would be talking more about yields rising a bit on the back of the data if we had just rounded up slightly to 0.3. I think the conversation would be modestly different.
Stephanie, it's good to see you. Thank you. Stephanie Roth there of Wolfe Research. I think some people on Wall Street having that conversation right now. You are seeing yields climb by a little more than 3 basis points, 3 to 4 basis points higher at the front end and into the belly. 2 years are at about 421 right now. 5s at about 437. Yields higher there by 3 basis points. Income better, spending better. PCE headline this close to a 0.3 print.
And some people on Wall Street are already saying that this actually would justify a hike. Omar Sharif over at Inflation Insights just out with a note saying hike territory. This is data that supports a hike. Talking about what Stephanie was just talking about, the unrounded core PCE was 0.246, so it barely missed out on a reading to 0.3%. Look, if it's that close, there is ultimately a real question about just how close people are to hiking rates. And ultimately, a real conversation about what hiking rates will accomplish. If you hike once, does it do anything? If you don't hike once, then are you basically saying you're going to be hiking 3 times or 4 times to potentially offset any momentum coming from where? From AI spending? I mean, ultimately, this is a complicated discussion happening at a highly politicized time, which is the reason why maybe put into AI. All right, say this now without getting the attention of the White House. Okay, say this.
That's the speech on Friday.
I think that it would be actually really interesting to run it through different filters and see what it says.
Rock and a hard place, right?
It's very difficult right now.
Some of it is his own creation, but he's in a tough spot into Friday.
Yeah, I mean, look, he could have just explained why the Fed remained on hold last time. At the same time, he did come out earlier and say that, he's not looking at 2 point something. He's looking at 2% target. Then he said, well, it's a little bit of, why are we parsing hairs here? He's talked out of a lot of sides of his mouth. Do we hear some sort of definitive resolution of some of the conflicts that he's created?
Up 3 basis points at the front end on 2s this morning, 421 on 10s, 465, 30s further out, only up a single basis point to 518. With an update on news worldwide with your Bloomberg brief, Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. Recapping the PCE data we just got. Inflation-adjusted consumer spending flat last month, following strong increases in May and June. The core number, which exclude food and energy items, advanced 0.2% from a month earlier and 3.3% from a year earlier. TWG Global says it's not selling sports assets at, quote, fire sale prices, and that the Los Angeles Dodgers are not for sale. The statement coming in response to what it calls speculation and misinformation surrounding the DOJ investigation into CEO Mark Walter. TWG Global says it's working with the DOJ and called claims of insurer fraud false and defamatory. OpenAI data center executive Chris Malone left the company last week, according to reporting from the Wall Street Journal. Malone's exit is part of a wave of leadership departures. This as OpenAI works towards an IPO expected in the next few months and races to catch up to rival Anthropic. And that is your Bloomberg brief. John.
Vonnie, thank you very much. Appreciate it. Thanks for this morning. Up next, we'll set you up for the day and the week ahead. Plus, we'll catch up with the Citizens Commercial Bank Vice Chair, Mike Lehmann, looking ahead to earnings from Nvidia, live from New York City. You're watching Bloomberg TV.
Today's core PCE just barely rounded down to 0.2. It's 0.2455. I think we're in an environment where the data will look a little bit cooler in the next couple of prints, such that the Fed can avoid hiking and do it credibly.
This close. Stephanie Roth of Wolfe Research on how close we were to a 0.3 print. So we come in on headline PCE at 0.2. Economists, the median, looking for 0.1. We're this close to 0.3. Yields are higher at the front end of the curve. You can bring up the bond board quickly, 2s, 10s, 30s. You see the move at the front end on 2s, yields up. But 0.3, would we really be having a different conversation based on that smaller move on headline PCE?
Well, Omar Sharif says that we already should be having that conversation. And some people on the Federal Reserve, Beth Hammack, Neil Kashkari, are already having that conversation.
They're right there.
They're right there. And if they want evidence, they can point to this. The onus is on explaining why you're not hiking if you have inflation running at this pace. And increasingly, over to you, Kevin Warsh, but also the other Fed governors. We have not heard from the other Fed governors since the FOMC meeting. We've heard from a lot of other people about why they potentially would be in the camp of hiking rates, but none of the other governors have dissented and supported hikes as soon as either September or shortly thereafter in response to the inflation.
You think the burden is on the doves into September?
Yes.
Okay.
I think that right now, that is the perception based on the rhetoric that we're hearing. The doves speak up. Explain why you're dovish. We've heard from some of the regional Fed presidents about why they think it's okay and appropriate to remain on hold, but the onus is on the data not to come in like this. Now the question is over to the people who want to stay on hold. Okay, why? And if you do, how much clout do you have on a committee that's led by somebody who really is a question mark?
Over to you, Kevin Walsh, in 2 days' time. Equity futures right now pulling back off the back of that move in bonds. We're down a tenth on the S&P and the Nasdaq down a third. As we count you down to the cash open with some simple names and morning movers. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Well, we start with a couple of companies that give us some glimpses into how the consumer is faring. First up, Abercrombie & Fitch, a heavily shorted retailer. It's up 13% in the pre-market now. It beat estimates significantly. Now, a portion of that was thanks to tariff refunds, which were massive, but not all of it. It turns out the consumer is still spending at Abercrombie & Fitch. Comp store sales were flat, but total sales, so not just the same stores year over year, up 5%. Hollister was up about 5%, and the namesake brand Abercrombie & Fitch also up. So it does turn out that consumers continue to spend on clothes. Now, if we look at the next company, J.M. Smucker, also higher in the pre-market. It also cheered investors. The only part of J.M. Smucker that didn't do so well was the total baked snacks. So you're thinking Twinkies and Hostess donuts, right? So they didn't meet estimates, but every other part of Smucker did. And the interesting thing here is what management said about coffee. So we know coffee had a massive price increase last year for various reasons, nothing to do with the war in Iran or anything like that. But obviously, coffee prices went up. J.M. Smucker put the prices up. Now coffee is in supply, and they have just started to pass those price savings on to consumers once again, so taking down the inflationary impact of that coffee spike. And then we'll finish with Intuit. So just when we thought it was all safe out there in the software world, maybe not so much. Now, Intuit did beat on revenue, but it gave much lower guidance than analysts were expecting. The stock is down 46% this year, even with August's 13% increase, right? It's not quite the SaaSpocalypse back again, because the company is doing a lot to try and get customers into its fold, so price decreases for the most part, but not a lot there that Wall Street was liking in those results.
Bonnie, thank you. Thanks for the update. A few names to look at. Going into the cash open, here's another one. It's Nvidia. Nvidia results after the closing bow following a 7-day slide into yesterday, which we finally snapped. The Citizens Commercial Bank Vice Chair Mike Lehmann writing, expects solid earnings from the company. They're the leader and continue to build durable technology and backlog. Mark joins us now for more. Mark, welcome. We've got some competition. How important is that competition, and does it begin to make a dent in the growth of this company?
I think it already has, Jonathan, and thanks for having me on. I think every quarter we're seeing more and more competition, but at the same time we're seeing them continue their lead unabated. So I would expect this to be a fine quarter. This stock hasn't done particularly well, even when they beat earnings expectations right after the quarter. But over time, obviously, the stocks perform mightily, and I'd expect that continue that trend.
Mark, John's been asking a great question all morning about the political interference with data center building and how much this could potentially curtail NVIDIA's forward look at their business. How much are you expecting to hear some commentary about this crimping some of the sales going forward?
It's a big issue. Obviously, the election is 100 days away, last 70 days away, excuse me. And I think it has become the issue nationwide, and I think it has to be addressed. I think it's hard for companies to address political situations, but I also think at the same time, there's the political pressures are out there, but also the economic pressures are even bigger. And there are some places that are receptive and some that are obviously wildly unreceptive. And I think that's going to be a narrative for some time now. And Jensen's really good at discussing these things politically, socially. I don't think it can be ignored, but I'd expect a lot more of that rhetoric into the election and beyond.
Do you expect to hear Jensen Huang talk about sales to other places other than the United States as the demand continues to increase around the world, in particular to China?
I do. I also think this has become not just a U.S. issue, although we are clearly the leader with data center expansion and the AI race. I think the globe has woken up. China's catching up. I've said for a while, I don't think they're there yet, but they're catching up. The government's backing their efforts mightily, as much as they can and much as they will continue to. So Jensen's really good at that. We've seen him when he's been in China at times. I expect that not to slow down either.
Mark, just how did we lose the public so quickly in the way that we have, Mark? What are your reflections on that, and what are people telling you?
You know, it's such a good question because there's both economic and political ramifications to this. And I think we've had this political theme for a long time about being left behind and sharing in this expansion. And at the same time, as the AI wave is so extraordinary and unabated, the question mark is what that does to the populace and what that does to the future of work and the future of economies. And I think it really is kind of interesting to watch as these data centers get built basically everywhere in these rural places as well as in urban or near urban. And the people watching this happen at the same time, their lives for the economy that we now have are not increasing equally. So it's a pretty easy thing for them to look at that and say, wow, isn't this great? And at the same time, it's not really helping me. I don't own any land. My job's being affected. This is really difficult, and I don't see this slowing down.
Mark Lehmann, thank you, sir. Appreciate it. The Citizens Commercial Bank Vice Chair. There is a boom, a technological boom taking place in this country right now. Very few people feel it. In fact, many people feel threatened by it in different ways.
I feel like we've come full circle. We started talking about Stan Druckenmiller using AI to write his op-ed in the Wall Street Journal, and we ended talking about why are people worried about the potential for AI to come in,
Sure.
and I think these two things are somewhat connected.
Hey, Bramo, safe travels.
Thank you.
Looking forward to the coverage on Friday. Lisa alongside TK and the team for Jackson Hole coverage on Friday. Coming up tomorrow, we'll catch up with Torsten Slok, Libby Cantrell, Francis Donald, Savita Subramaniam.